Hey guys, welcome to the Smart Money course. This is Arshal Haq, and today we're gonna talk about the first lesson, which is Introduction to Smart Money. I've got a little cold, so excuse me with the coughs, and so I'm gonna try and keep this within 10 minutes or less. I'm gonna try and keep every video within that, because that way you can learn faster and better. So let's begin. So, what is really smart money? A lot of you have heard smart money, the word before, and what is it really? Is it like you've heard words like smart money, institutional trading, trade like the banks, stuff like these, and every one of them is literally the same thing. It's literally institutional trading. What the big banks, the market makers, the central banks are doing, the ones who are actually controlling the markets. Now, to learn this, first you gotta know this, that the market is controlled. It's controlled by the big banks, the ones who are actually putting in the orders and moving the market so that there can be so many people trading and they can make money out of it. So let me tell you how it's actually happening and what is the difference between retail and institutional traders and smart money traders. To begin with, think about it this way. You control the market. Suppose you are controlling the market. This is the market and you're controlling it. And the people who are trading in the market are 90%. Suppose you are this one. Suppose this is you. This is you. Change the color. This is you. And you see that 90% of the people are here, over here, trading like this. Right over here in this road, and you start trading, and when you begin you see only one or two over here, and what would you do? You would definitely go to the path where more people are, right? You're gonna choose the path where more people are heading into, and this is pretty natural. This is how our psychology works. And to be very honest, everybody, even me, we all start with retail. We know, we learn trend line stuff and stuff like that. Now think about it. Let me give you some examples. Chart patterns, Forex. So think about it this way. I'm pretty sure if you're learning this course, you know these double top, the head and shoulders, the rising wedge and stuff like these. Now think about it. If 90% of the people are trading the same thing, if trading was that easy, why isn't everybody making money? Why are the people who are teaching you not making money? Why is it that everybody is not rich if trading was that easy? The reality is because everybody is doing the same thing. And think about it, if you are the market maker and you are seeing that everybody is going buys, what would you do? You want to make money, you got to go against them, so you just sell the market. And that is how the markets are being controlled. And now what I'm going to teach you is how to see the patterns, how to see where and how the market is being controlled. Now I've been doing this for a while now, almost 2 years now, and it is pretty interesting. The only reason I'm teaching you guys is because you might learn better from me. Every educator is different. This is gonna provide me some passive income, and it's gonna help me as well improve my concepts. And I've got a lot to teach. I've learned a lot by myself, not from some mentors. I've learned from mentors as well, but a lot of things by myself, by backtesting and stuff. So this is what I'm going to show you, and this is just the introduction of how it's actually working and what is actually happening. We've got a lot more in details within the course, but this is pretty much it. Smart money concepts are basically the central banks, the big banks, the ones who are actually trading the market. Now let's look at something else as well. Think about it this way. You are thinking double top, right? I'm actually gonna do this in the next video, so I'm gonna keep this one short. I hope you understand what smart money really is and what the institutional trading really are. It's knowing where the banks are in the market, and to trade with them, it's really important. And let's see you in the next video. Hey guys, welcome to the introduction to smart money part 2. So let's get right into it and talk about what's really happening in this market. So as you know, and as I've already talked about it, that the 90% people are doing the same thing in this market, which is why the 90% are losing. If you look at Forex success rate, it's 90%. 90% people are losing. They do not succeed. And some even quote it as 95%. So you can imagine how hard it is to win in this market. You gotta be on the right side. You cannot win unless you're on the right side and you've got the right mindset to do so. And it's quite obvious that if 90% of the people are doing the same thing, and if you're the market maker, if you're the big banks, you can easily manipulate people into doing something. Like you put them into buying whereas you want to sell, and that is exactly what's happening. And let me get into it and show you what's and how they are doing it. So as you know, we talked about Forex patterns, and if you're a trader and you've been trading for a while, you should know. If you're a basic trader, you should know what a double top is, what a double bottom is. And almost everybody knows this, and this is what they take advantage of. This is what they want you to learn. This is why it's all over the market. This is what all over the internet. This is why it is all over the internet. What is really happening in here? Let's see. You can see this is a double top, right? It is a double top, and what we are taught in a double top is usually the retail traders are taught as soon as there's a break over here, you sell the retest. That is pretty much it. That is what they're taught, and some even sell it as soon as they see the move in the resistance. Now, suppose for this example, just for this example, you gotta think that there are only 100 people trading in the markets. Only 100 people. Now, this is just because of this example, so that you can get it right and understand the concept, what I'm going to teach you. So this is just an example to show you what's really happening. So let's say there are 100 people trading in the market, and out of those 100, as soon as there's a double top and the market starts moving like this, say market's over here and starts moving, there are people already selling the double top, which are these people, right? They are selling already the double top. Now, what is happening? If you are selling the double top, where would your stop loss be? Stop loss would be somewhere around here, right? Somewhere around here, above some high, above some previous high, right? Which is where there are traders. So let's say for this example, out of the 100 people, 20 traders are selling the double top right away, and their stop losses are here, and 50 traders would buy stops over here, expecting the market to go up. They're expecting a bullish move. Sorry about that. So they are expecting a bullish move. Now, what is really happening? 20 traders out of the 100 selling the double top. 15 traders have stop losses down here. 20 traders have stop losses down, and 15 traders are put in buy stops, expecting the market to rally up. Now, some, as I told you, as what they're taught is that as soon as this breaks, you gotta sell the double top. You gotta sell the retest, right? You gotta sell the retest. So what's happening is these people are trying to sell the retest over here, right? These people are trying to sell the retest over here. What is this? They are trying to sell the retest over here, which is basically this, right? Yeah. So they're trying to sell the retest, and these are 15 traders out of the 100. So we so far have 15, 30 and 20, 50 traders out of the 100 already in the market. And there are some traders who and where would the stop losses for the sell limit be? it's gonna be right here, right? It's gonna be right here. Sorry, my bad. Violently. Sorry, I just got a cold, so I'm coughing a lot. So we have this. So far, 15, 15, and 15, 45, and 20, 65 traders in the market. What are these traders doing? They are expecting the market to rally up and then sell and then buy the retest, looking for a more bullish move. Now what's happening again? Let's see. These people have stop losses. Where are the stop losses for these people? Over here, below the low. Everybody wants to keep the stop loss below the low, which is what we are taught. What every one of us are taught is your stop loss should be above the high or below the low. Now, there are some people who are selling here with the momentum. As soon as they see the market moving, they sold it here. And they sold over here. And these are 10 out of the 100 traders. And for some reason, there are some traders, what they do is, they just want to go against the market. For some reason, they think the market, if it's rallying down, it's going to go up, it's going to reverse. And these are the 10 traders that are doing that. I'm pretty sure you have been there. You know how it works, how sometimes you see a resistance and support, you want to just buy. You think market's going to just rally up and stuff like that. So we got so far 85 traders in the market, and there are sell stops right here. Where are the stop losses for the sell stops? Above the high. Where are the stop losses for the buys? Below the low. Really sorry about the cold though. So let's see what the smart money is doing then. We got all 100 people in the market so far. Well, not 100 exactly, this should be 10. Sorry, my bad. We got 90 people in the market. And what's happening next? Let's see. This is what the 90% is doing. You see 90 people are doing this. Smart money. Let's remove this. Smart money, what they're doing is they're pushing the price down so that people get enticed to do all these. And then they will push the price up just like this, triggering all the stop losses of the buys and the sell stops. And then, so basically they're triggering all the buy stops and sell stops and the stop losses, the sell limits, and then just pushing the price up like this. Just like this. They push the price up, take out the equal highs, take out the double top. Everybody's out of the market, and then they push the price down. And then they push the price down. You see what's happening in here? They are taking everybody out of the market, everybody out of the equation. This buy stops over here are stopped out over here. The sell stops over here are stopped out over here. The buy limits are stopped out over here because the stop losses are below the low. Remember, the buys stopped out, sells stopped out, sell limits stopped out. Everybody stopped out of the market. And this is where we begin. This is where smart money begins. And what we do is, as smart money traders, we look for this to happen. We look for smart money. This is an example of smart money getting into the market. And when we see this, we want to buy somewhere around here. We want to sell somewhere around here. Sorry. So we want to sell somewhere around here. And then continue selling down from here. Say position somewhere around here like this. Pretty much this is the concept, and I'm just gonna keep it short and keep it to this. If you have any questions, DM me. Make sure to follow me on Instagram. Wait, with our show. Follow me there. Looking forward to seeing you guys. Hey guys, welcome to the Smart Money course, and this is the third video of the course, and it's called Liquidity. Now we're gonna start with what liquidity really is. Alright, what is liquidity? Yeah, so liquidity, first of all, is a really important chapter of this course. Because why? Because if you don't know how to find liquidity in the market, you cannot trade these concepts. Simple as that. If you don't know how to find liquidity in this market, you don't know how to trade this concept. And finding proper liquidity, as in proper money. What is liquidity? Liquidity is basically money in the market. Where is the money in the market? That is where liquidity is. Liquidity means let's do equal money in the market. Now where is the money? That's what I'm going to teach you, and that's where the liquidity is. Alright, now if you don't know how to find the money in the market, you cannot treat these concepts properly. So please focus, and please focus on this chapter of the course, because it's really important. Now let's begin with alright, now let's begin with how do you really find these money in the market. Now, as we've already talked about, double tops, double bottoms, alright, double tops, double bottoms, other stupid patterns, trend lines, alright, consolidation, stuff like these. Alright, now these are some examples of liquidity. I'm gonna show you how. Now let's start with double tops. Now, why are double tops liquidity? Simple as that. Like, if you understand this one, you will understand most of it. The simple reason is because there's stop loss down here, right? So simple reason is there's stop loss down here, and there's money in the market. As a smart money trader, as I already told you, the first thing that you have to learn when you're trading smart money is that you are the smart money. Alright, you have to believe in it, that you are smart money. So if you are smart money and you're controlling the markets, what do you look for? You look for the money. Now where is the money? You know, the monies are basically in the stop losses and the orders. So where are the orders and the stop losses? When you think it like that, where are the orders and stop losses? Over here, right? Over here. It's basically in there, right? Over here and over here. So we know the stop losses and the orders are down here, as I previously already taught you how the market really works. If you don't know, please look at the last video of this course, which is the second video basically, where I explain the concepts on how the orders are filling and how the stop losses are being taken out. So as you know, the orders are here, so all the money is down here. Okay, so that is the liquidity. Okay, that's liquidity. Where the money is liquidity. Where money is stop losses and orders. So you gotta think it like that. Now again, let's think of this pattern. What is happening here? We can see this is a trend line, right? And this as well as a trend line. Now these are liquidities. These are liquidities, alright? These are liquidities. Why? Because again, trend lines, people tend to sell over here and people tend to buy over here, right? Over here. Because these are retail patterns, and 90 to 95% of the people are doing this. So you you must remember that. Think about that way, what's gonna retail do in this market? What is retail trying to do over here? Think like that. The third would be just another pattern is this one, which is basically consolidation. The whole thing is a liquidity because there's a lot of buys and sells and stop losses down here. And if you don't know this, I don't know what you're doing trading. This is pretty simple. Consolidations are pretty simple. This is an advanced course, so you should pretty much know it that there's a lot of orders and a lot of stop losses down here everywhere basically. Now this interesting bit of it is there's a fourth way I can show you what liquidity is, which is basically say this is a downtrend, right? Now what's happening in here is basically every high and every low is liquidity. Liquidity, we term it as LQ, okay? LQ, as you see here, LQ. Every high and every low is liquidity. Now this is pretty simple to understand. Why? Because stop losses are above every high and every low. Simple as that. Now if you're buying here, your stop loss would be down here. And if you're say selling here, your stop loss would be down here, up here. Why? Because that's how we work as markets. That's how we tend to learn that stop loss should be above the high and stop loss should be above the low when you're buying. So simple as that. Remember this bit of it and you're done for it. Now let's go to the charts and try and find some things. I haven't looked at the charts yet, so this is pretty basic. I'm just gonna go very natural on this. Yeah, this over here is liquidity, okay? Why? You can see that here's a double bottom, almost a triple bottom, you can say, and it's been taken out. You can also see it's been taken out. I tend to mark liquidity with a dollar sign. Let's find some more. I don't know if this is a proper chart to do so, but let's try and find some if there are. Basically, yeah, this is very nice liquidity taken out. You can see down here, right? So liquidity over here as well. I can try and find some trendline setups as well. I'm gonna attach some screenshots in the end by trying and finding some. Right now I'm just doing some just some natural stuff to try and find live for you guys if I can. Some over here, look at this is so beautiful. Liquidity down here, what does the market do? It takes them out, right? Takes them out completely. And this is what the smart money is trying to do. So you gotta try and find liquidity. Also, most importantly, one more thing, liquidities are targets, and basically they are targets always. Hey guys, welcome to a new video of the Smart Money course, and this video is called Market Structure. And what is market structure? What is market structure? Alright, so market structure is basically helpful for you to know in what direction you should be trading. Alright, so let's say suppose the market is trending upwards, alright, and with the help of market structure you can understand if you should be buying or selling in this market. Alright, and why market structure is really important, because this pattern keeps on repeating. It's kind of complicated at times, which is why I have another episode and another video of this in the course, which is market structure advanced, and I'll go through in-depth market structure in that video. For now, this is gonna be just the basic. Now, to understand market structure, you need to understand higher highs, higher lows, lower highs, and lower lows. Now, what are they? I'm gonna show you, don't worry. So, to begin with, how it works is basically market moves in cycles. So market keeps on forming the same patterns to move itself. So basically it either forms higher highs and higher lows, or lower lows and lower highs. So so basically it goes like this. All right, so higher highs, higher lows, higher highs, higher lows, highs, higher lows, and then suddenly a lower low forms, and then again lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So this is kind of just an example, just the basics of how market moves. Now, just to give you the example, over here, high, 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 high. All right, and over here, higher low, right? Higher low, higher low, higher low, higher low, higher low. Again, another one. And this is a lower low. Now, when a lower low forms, that's when the market structure is shifting. All right, lower high, and this is basically what it forms. All right. So yeah, something like this. Yep. And yeah, so this is basically how it works out. Let me just write these down for you guys. Higher high, higher low, lower low, lower low, lower high. Now, this is just basic of market structure. As I said, we're gonna have a more in-depth video in the future where it's called Market Structure Advanced. Now, the basics, basically, you can easily see here that the market over here, the structure was broken, right? Over here, the structure was broken. It formed a lower low, which means that it wants to go down now. Now, this lower high confirms the lower low. Until this lower high is formed, this is not confirmed. This can just be a liquidity capture, because as we know, stop losses are below the low. So as soon as you see a lower high form and then a lower low form, that means market is shifting structure, which is market shifting its trend. Now, so far, when you have just this much, you can already tell that the market is bullish. Why? Because it's forming higher highs and higher lows. So when you see that, what you start to look for is buy setups to go long and not short. So this is why it helps a lot, because you can understand if you need to buy or if you need to sell. So when you see the market trending upwards, you can easily just start looking for buys. And same goes when you see market shifting structure, and then you can easily just start looking for sells. This is really helpful when you trade, especially from the higher time frames, because you can understand where the market is heading long term, and it helps a lot. So let's get into the charts and show you some examples. Let's look at this, for example. Let's say, let's see, just trying to find an example. Yeah, this looks good. Yeah, this looks good. So we can see over here that market took out this liquidity. It was trending downwards. Over here it was trending downwards, and then it took out this liquidity, and what it does is form a higher high, right? Higher high. So the structure is broken. Now, as soon as a higher high is formed, we are expecting a higher low, as we know, right? So a higher low is formed, and then this is the structure, so we're expecting a higher high again, and it doesn't form a higher high until over here, higher high, and then another higher low, again another higher high, another higher low, and so on. So you can see, I will just mark this up for you again. This is a lower low, right? Sorry. Yeah, so this is a lower low, and let me just put this down. Yeah. So this is a lower low, and we are expecting a lower high. However, it forms a higher high. Why? Because the liquidity is taken and it wants to go up, right? A higher high, and then we have a higher low, right? Higher low, and it goes like that. Just keeps going like that, right? Over here and over here, and then again another higher high. Now we're expecting a higher low. It does form another higher high until over here, and then forms a higher low again. So when you see something like this, suppose you have the market till here, all right? You saw the market, suppose over here, right? Now you can already start looking for buys around these areas, right? Because you know the market's trending upwards. So if you wait for it, and if you can understand the move, you can easily catch this buy, especially over here, because it looks super good. And same goes for the next setup. If you know the market's trending up, you can easily look for a buy around this area, and it's exactly what happens. Yeah, exactly. Bang, gone. So market structure helps you know the trend, know the bias, and especially when you're trading long term, especially when you are trading from the long term, bias, helps a lot. And I'll talk more about it. This is just the basics of market structure. I'm going to talk more about it in that one section, because it helps a lot when you look at it in a different way that I'm going to show you. Also, just an easy trick about market structure is basically to understand if the structure is broken or not. You must start looking at the candles, which is the bodies. Alright, market structure equals bodies and not wicks. What do I mean by that is basically when this is broken, when this body is broken, when a body closes above this line is when a higher high is formed. Same goes over here. When the body closes above, a higher high is formed, not the wick. Remember, not the wick. The wick doesn't matter. The body has to close above. Same goes over here, right? The body has to close above. That is why this is not a lower low, because the body did not close above. Same goes for this. The wick closed below, but the body did not close below, which is why it's a lower high, right? So bodies and not wicks, this is a key factor while trading, while understanding market structure. And another easy way to look at it is just change your candles into line chart, and you can easily see if it's broken or not, because the line chart doesn't show wicks, it only shows the bodies. So this helps a lot as well. So I'll see you in the next video. Do follow me on Instagram and catch me up on Telegram or Instagram if you need any help. Thank you. Hey guys, welcome to a new video of the Smart Money course, and this video is called Risk Management. So before we begin, I just want to say that Forex trading contains risk of real money. So this is a disclaimer, that's pretty much it. Now let's begin. So what is risk management in Forex and why is it so important? Basically, if you're trading, say there are 3 different type of traders right here, alright, and every one of them is trading differently, okay? So, or let's say 2, okay, no, let's say 3, that's good. So what you are doing different to any other trader is, what I am doing different to any other trader is, my risk ratio, my risk to reward ratio is always greater than 1:5 or 1:5, greater or equals to 1:5. Alright, so basically this. So if you're a trader who's always, when I first started, I was always doing 1:1 or even less, which is so bad, which is kind of horrible really. So that was back in like two years ago, so that's super bad. So now I'm doing 1:5, right? And some people are doing even worse, which is say 2:1. So now think about it. If you have more risk than reward, your accuracy of trading has to be really good, at least 80 to 90%, right? 90% maybe, at least, and still you're gonna have it really difficult to make money. However, if it's 1:1, it's pretty much the same thing. You're gonna make a little more money with this accuracy, but it's still not enough to be in this market in the long term, because no strategy in the world, to be very honest, if anyone's selling it, it's basically a scam, because most of the time now no strategy can get you consistent 80 to 90%. And the reason of this is because it's very simple to understand. Think about it. why can't a strategy have 80 to 90% success? Because the market moves in cycles in different ways, alright? The market, the way it moves during November, December, January won't move the same during June or July, because the end of the year is different, the beginning of the year is different, the middle of the year is different. Every time of the year is different for the markets. Why? Because these financial markets move based on financial news and how the world is going on, etc. Such as this COVID pandemic. COVID pandemic completely changed the market, like completely changed the historic market. So many things happened. The Australian fire that happened, and that changed completely how the dollar and the Australian dollar worked. So you need to understand why it's not physically possible, at least in my eyes, in my opinion, it's not possible to have this much accuracy consistently every time you are going to trade. So why is risk management important? Let's say I'm doing 1:5, right? So if I'm doing 1:5 with just an accuracy of around 40 to 50%, I can make really good money. Think about it. When I'm risking, say, $100 per trade, alright, $100 per trade risk, alright, $100 per trade risk. I'm doing over here, down here, and down here, all three, alright. And I take, say, 10 trades a month, 10 trades a month. This is just an analogy and just an example, alright. Nothing too serious, just to make you understand how and what's happening. 10 trades a month, on all three occasions, alright. Now these are three different traders. Now this trader, if say he loses around say what you call it 2 times with this accuracy, alright. So let's say me over here, this, as I said, it's not possible to have what you call it this much accuracy, right? It's physically not possible. So let's think about this one, alright. Let's think about this one. If you have, say, 40% accuracy, or let's go with 50% first. If you have 50%, so I'm just gonna delete this because it's of no use, because I already told you why it's not possible to have 82. Even if you do, it's not worth it. Believe me, it's not worth it. Now let's begin and show you how it's actually working, alright. Just a second. Okay, awesome. So yeah, let's keep it down here, right? Okay, so let's say we have 10% accuracy. Now let's go with 20% accuracy, see, 30% accuracy, 40%, 50%, right? Oh, let's do it like this, 50%, alright, some different. Now these are accuracy, alright, these are accuracy. Now I'm just gonna show you why risk management works and how it works so deeply awesome, alright? Because I've stuck in for so long when I wasn't doing good, all because I started Forex with pretty good risk management. The first few months I wasn't good, then I realized risk management is important, and I didn't even know smart money back then, but risk management still helped me. To be very honest, when you're trading, whatever concepts you're trading, risk management is everything in the end. So let's begin and show you how it works. So let's say you, out of 10 trades a month, you have an accuracy of 20%, alright? So that means you're winning 2 out of 10 trades, right? 2 out of 10 trades, right? And that means we are risking 100 per trade, and our reward is 5 times, right? And our reward is 5 times. Over here, same thing, except 3, and over here, same thing, except we have 4 wins, and over here we have 5 wins, right? And the reward is the same all the time. I've gone up to 1:29, 1:30 reward, and even more sometimes, but I'm just trying to show you how 1:5 can make you like huge. You don't even need to get that much, alright? But this is just an example. So if you're winning just 2 times and losing 8 times, which is basically 8 into 100, right? So that means you lose $800, right? you lose $800. Shit, my bad. To $800, right? And over here you're winning $1,000, right? Equals $1,000. So your overall, even after winning just 2 trades out of 10, your overall profit remains $200. You can see how powerful this is, how powerful the risk management is, and why I recommend you to. I'm gonna show you how to do it. This is just to show you why it's so important. Alright, trying to keep this video as short as possible, so you can imagine what's gonna happen here as well, right? Now we got $200 down here, $200. Yep. Now if you look at this, same thing. You lose 7 out of 10. You have $700 loss. Profit overall equals $300. Sorry, my bad. It should be more because you got basically around 3 into 500. Just a second. 3 into, I'm so bad at maths. I'm so sorry. Yeah, that's 1500. Yeah. So 1500 minus 700 equals basically what you call it? Damn, I'm so bad at maths. $800. So you can see the difference. You can also imagine what the profit is gonna be down here, right? You're losing with $600 down here. 600. That's pretty much it. Risk management's pretty much it. Like, you gotta understand how you got. The thing about it is mostly psychology to understand that the next trades are gonna make you the profit. You need only 2 or 3 wins per month. You don't need like 10 wins. You don't need to trade every day. And even if you want to, there's a different way for it. I'm gonna show you every way of it. But you get the idea of risk management, what I'm trying to show you. And I'm gonna show you how to do risk management in the next video. Thank you. And please do follow me on Instagram. And if you need any questions, get on me on Telegram and we'll talk about it. Guys, welcome to another video of the Smart Money course, and this video is called how to do risk management. As a disclaimer, Forex contains risk of real money, so that's pretty much it. Now let's begin. In the previous video, I showed you how to do. I showed you what risk management really is and how it can be helpful and how it can make you grow in the long term. I'm gonna give a trading plan in a few videos later, like a big trading plan on how you can use risk management and money management to go big in the future, in the long term. Now, in this video, I'm just gonna show you how to do risk management. So, how to really do risk management? All right. Now, it's pretty simple. Most people struggle with this because they don't know and they've been taught the wrong way. The first step to do is stop counting pips. Now, I know this sounds weird. Most people won't teach you this. This sounds really weird, but the reality is, as soon as you start counting pips in this way, you're gonna struggle with the money management of your account. Let's say you have $500 or say $1,000 account. Most people I know start trading. They take a trade, think I'm gonna do one lot. I'm gonna do say or say half a lot. Just saying. Or let's say 0.10 lot size. All right, and I'm gonna risk 25 pips. Now, this is how most people trade, all right? However, they don't realize how much they're risking, all right? Or let's say 0.15, that'd be better, yeah. So, and they don't know how much they're risking. Can you tell me how much you're risking? No, you don't know. Nobody knows. The people who are taking this trade, they don't know how. They just think I'm gonna take the next 10 trades. I'll take with a 0.20 lot size. That's how they do the risk management, which is wrong, which is super wrong. What you have to do is understand how much you're risking. even before you take a trade, you must know how much you're gonna risk. For me personally, every time I take a trade, I already know how much I'm risking. Suppose you have $1,000 account, alright? $1,000 account. And you're gonna risk 3% of the account. Let's say 3%, just for the sake of it. 3% of the account. And $1,000 account, you're gonna risk 3% of the account, and the risk reward is 1:5. Alright? Now what you do is you take a trade and you risk 1,000 into 3% equals $30. Alright? $30. Now you know you're risking $30 every time you're going in a trade. That means you also know your reward. That means if you win, $30 risk and reward equals 5 times equals $150. So every time you win, you know you're gonna win $150, and every time you lose, you're gonna lose $30. Now this is how you're supposed to do it. Now how do you do it? You go to Google every time you go to Google and write down position size calculator. Alright, you go in there, you enter MyFXBook position size calculator, and you wait for it to load. Then you fill in what's going on down here, right? Your account currency, your account size, which is say $1,000 just for this example, your risk ratio 3%, or you can also use a switch to money and write down 30 USD. I'm gonna use the risk percentage, and then you write down the stop loss. Say we have a 20 pip stop loss, alright? And then you select the pair. Suppose that now this is the key part. When you're trading you on a USD account and your end of the pair is USD, it's gonna be really simple to understand. It's 0.15. But as soon as you change the pair, because your broker is gonna convert the money, your broker converts the currencies. Alright, so this is why the lot size matters. Most people don't understand and keep on doing the same lot size every time, but this is why it matters. So you gotta do, say, like if it's GBP/AUD, it turns into 0.194. You are doing more 0.4 lot sizes, whereas you were doing 0.15 when it came to USD, right? So, and in Canadian dollars, again, you're different. And say NZD dollars, NZD, you're again different. So this matters a lot, and this is why you have to use this position size calculator, because you must risk a specific amount every time. You cannot go on and just do lot sizes every time, because what's gonna happen is if you keep on doing that, sometimes you're gonna risk $10, sometimes $12, sometimes $16, and you won't know what you're doing. You're just spamming the lot sizes even though you don't know what how much you're risking. So this is really important to understand, and that's pretty much how you do it. Also, if you don't know, if you don't have this, if you cannot always get on this and you're on your phone, there is this app called Steno, which is a really nice app for this. Steno, I'm gonna write down for you. Steno, right? So you can download the app as well. It's very nice. It's helpful a lot, and that's pretty much it. And I'm not sure if I have anything more to say, but yeah, that's pretty much it. So if you think about it, you must understand this, how you're doing it, and let's say, yeah, that's pretty much it. Yeah. Also one more thing you must understand and must actually keep it in your psychology, but it helps your psychology, is try to look at your account in the perspective of percentage and not money or pips. So let's say your account is $1,000. When you win and you go say $1,150, because 5 times, so try to look at it this way, that you are up 15% of your account. Alright, don't look at it as I'm $150 up of my account. Try to look at 15% of your account. Now if you're down say $970 from $1,000, so then think of it that I'm 3% minus 3% down of my account. Don't think of it in the different way that I'm down $30, because in that way your psychology, your brain's gonna think I need to make that money back. No, you don't. You just gotta take another trade, and it's gonna come back. Don't worry about it, because the risk management is important, and this, looking at your account in percentage wise, helps a lot. I cannot stress this enough. A lot. So that's pretty much it. See you in the next video. I hope it helps. I'm gonna keep another session, and I'm gonna try and do more and more sessions based on these in the future. And thank you. Do follow me on Instagram, and see you in the next video. Hey guys, welcome to another episode of the Smart Money course, and this video is called Institutional Candlestick or Order Blocks. Now, before I begin, I just want to give this disclaimer that Forex trading is risk and contains risk of real money. So that's pretty much it. Yeah, let's begin. Sorry. Now, to start this video, I'm gonna first tell you that smart money banks, like basically banks, the institutions, for them to move the market, they have to buy. They have to buy over here. Okay, so they have to buy to sell and sell to buy. That's how they move the market. Now, I'm just gonna make this easy for you. I'm not gonna go in depth. I'm just gonna make this easy. Just remember this, that they have to buy to sell and sell to buy. Alright, so when you have this in your head, now you can understand what an institutional candlestick really is. Alright, suppose over here, alright, an institutional candlestick is basically the last candlestick, which is right here, okay, before a big move. Now this move can be bullish or can be bearish. Either way, it can be a sell or a buy. But the candlestick just before the big move, which is over here, is an institutional candlestick. I'm gonna give a lot of examples during the end. I'm gonna try, if there's time, I'm gonna try and give you some live examples. If not, I'm gonna give some screenshots. So basically the last candlestick before the big move. Now, what is actually happening here? Alright, so before they go bullish, remember they had to sell to buy, right? They have to sell to buy the market and buy to sell the market. I'm just gonna make it that easy for you. I don't like to complicate things, it's that easy. So over here they have a lot of sell orders, right? They have a lot of sell orders. You have to remember this to understand the whole concept, okay? They have a lot of sell orders before they bought. Now, remember how we trade? I showed an example in the first few videos. So how we trade is basically, say liquidity down here, right? Liquidity, market takes out the liquidity, we go down, and here's our entry, right? And bang. So this is our entry, okay? Now if this is the entry, what are we expecting here? An institutional candlestick, which is basically this one, right? A buy candlestick over here before the big down move. Alright, and they also took out liquidity. So a buy candlestick before the big down move, and then the market comes back to the institutional or order block. Why do they come back? That's where the important thing is. And that is the main concept of institutional candlestick or an order block. I like to call it IC basically institutional candlestick. That helps me more. I don't know why. I like order block OB as well, but I like IC more. Anyway, so when you see this, alright, now what's happening is basically, why does the market come back? I'm gonna go in depth in the later sessions. This is just a course of institutional candlesticks, so understand that the market comes back because remember, they had to buy to sell. Now, as they move the market, and literally there is no buying here, right? Because the market is so bearish, there is literally no buying here. So what's happening is all the buying was down here, right? So that they can lure the retail traders and they can move the market downwards. So when they did that, they left a lot of orders down here, right? A lot of orders, like a lot, all buy orders. So they are in huge drawdown, but they're smart money. They are big banks. They can hold drawdowns of like millions of dollars, right? So for them, it's no problem. What they do is they move the market down and then come back to this candlestick to close these positions, to close the buy in break even. All the buys, they take some profits down here and go back and fill more orders in and then go down again. Basically down here, right? Over here in institutional candlestick, they went down, they came back to close all the orders down here, and then also they took some profits down here and then they went back again. This is how the market moves again and again and again, and this is a repetitive pattern. You gotta follow this, alright? Now, there's also another type of institutional candlestick also we can call, I like to call that an FU candlestick. An FU candlestick is basically saying, you know, FU, like FU. So what it's doing is basically FU candlestick. The difference between an FU candlestick and a normal institutional candlestick is FU candlesticks are even more stronger than institutional candlestick. That means there are more orders. Like there are more orders, so it's more likely to work out. Alright. There are more orders, so it's more likely to work out. Now, how do you know if what is an FU candlestick? Let me give you an example. When there's liquidity, we have already gone through what liquidity is, so you can understand. So this is liquidity, right? Double top. Now, when this liquidity is taken out before a big move, alright, when it's taken out before a big move, over here, let's say over here, right? Let's say we carry this one. Yeah, this should be good. So over here, this is the FU candlestick. Why? This green one is an FU candlestick. It's the same as an institutional candlestick, except an FU candlestick also takes out liquidity. Alright, so it has captured this liquidity. We can already see it has captured this liquidity before going down, right? It took all the money away, trapped all the traders, and then went down. So that means there are more orders in here because they had to push the market up, right? They had to push the market, so there are more orders in here, which is why an FU candlestick or an institutional candlestick, and if FU candlestick basically is even more stronger than a normal order block or an institutional candlestick. Why? Because there had to be more orders in there. So these are the type of trades we're going to try and look for more and more and more and more. I'm going to go in depth. We're just starting. I'm going to go more in depth throughout the course. This is literally the basics of it. We have bonus sessions, which I'm going to do at least around 30 minutes, I guess. 2 bonus sessions, so they're going to be each around 20 to 30 minutes of me just showing you concepts and concepts and concepts. So I'm going to try and do that as much as possible. So this is pretty much it of an institutional candlestick or an order block. If you have any questions, just hit me up on Instagram or Telegram and we'll talk through it. And do follow me on Instagram. Let's see you in the next video. Thank you. Hey guys, welcome to another video of the Smart Money course, and today's topic is gonna be imbalances. And before we start, I just want to say this disclaimer that Forex has risk with real money, and that's pretty much it. Let's begin. So what is an imbalance? Imbalances are really easy to understand. Alright, it's super easy to understand. All you need to do, the harder part about imbalances are, it's harder to train your eye, but it's not hard. I would say it just takes time. It's gonna take you like a day maybe or 2 at max, and you're gonna be good. Alright, so what are imbalances? Imbalances are areas in the price where there are excess of buys or sells, which is why the market cannot match both the orders of buyers and sellers. What this means is, have you ever looked at a market and you've seen that the market's just going up, like just going up, rallying up without any, without stopping, it's rallying up, and suddenly what you see is there are only blue candles or only green candles. Why? Because it's only going up. No red candles at all, no bearish candles at all. That's where imbalances are usually formed, and this happens because there are so many buy orders that the market cannot fill in. There are lacking of sell orders, which is why the market cannot match them. So this happens a lot in the market, and imbalances are basically, in other words, how I see it, it's basically a gap in the market treat it as a gap. You know what gap is. Gap basically is an area where same thing, market could not match the price, and so it returns to it to match the price later. Alright, so the imbalance is basically the same thing. It cannot match the orders. That's why an imbalance is formed, except an imbalance is formed in disguise, so you cannot actually see the gap, but there is a gap. For example, if you look out here, alright, on this left hand side we can see that this is a gap, right? This is a gap. The same pattern is down here, except this is also a gap. Think about it. If I remove this candlestick, say this one, right? I remove this candlestick, right? If I remove this candlestick, say gone, what happens? It's a gap, right? Same thing. So it's happening in disguise. You're just not understanding it. Now, the easiest way to understand is the bodies. If you look at the body has not, these two wicks have not met together. So how could this not be an imbalance? Suppose if it was something like this and the price, that means that the price is balanced. Why? Because both the candlesticks have met together. So there are no, like, if I do this, for example, if I do this and this, is this a gap anymore? No, it's not. Why not? Because the price has been there in both occasions, right? So that's pretty much it about imbalance, to understand what a gap or an imbalance is. Now, to understand or to find more imbalances it's kind of difficult while looking at the charts, and with time you're gonna get used to it. But to understand it, the simplest way to look at the wicks and the bodies down here. The body usually is the imbalance because these prices haven't met together yet. So there are too many buy orders down here. Too many buy orders, less sells, right? So that's why it was not possible to match the orders. And even more easily to get it, like, just treat it as gaps. How you treat gaps, think about it that way. Now, imbalances are attractions to the market, alright? So if this is an imbalance, price tends to attract imbalances, alright? Tends to attract towards imbalances. So what that means is basically prices reach imbalances and react out of them because of, as you know, there are orders that are, there are sometimes more buy orders and sometimes sell orders, depending if it's bullish or bearish. So that's why price reacts to it a lot, and it's a very, very key area. It's a key area, you should know that. Let's get into the charts and show you some examples of imbalances. Let's say, for example, over here, alright? If you look at this, same thing, alright? Same thing, 3 candlestick. Down here, these two wicks, this candlestick had too many sells down there and less buys, which is why it created an imbalance. If you look at this, right? Imbalance. This and this never met. So here was lacking of orders. Again, same thing. Sorry, my bad. Same thing I can say over here, right? Pretty much the same thing. Too many buy orders down here, so it created a difference in the orders, and therefore an imbalance was formed. Imbalances form a lot. Again over here, right? Same thing, pretty much. And it did, actually this was the imbalance. It did reach the price later on, right? Which is what I said, that because it's a key area, these are key areas, and it's very, very strong areas. Imbalances are very strong areas, especially on the lower time frames. Look at this again, same thing. See, again, the price reaches back to the imbalance, and I can show you like thousands of imbalances because I have my eye figured out, right? I can look at it and just say what an imbalance is. Like, I can literally mark up imbalances non-stop, literally non-stop. Like, I'm not even kidding. Okay. Again, down here. So I'm gonna like, I can show you as many as you want, as needed, but what the important thing is to understand your to train your eye. It's pretty simple. Just look at the market, try to find, especially sometimes 3 candlestick pattern. This helps a lot because most of the time the imbalance is formed within this 3 candlesticks, as I showed in the tutorial above. It's very simple. Again, over here I can find them like all day, like it's so damn easy. Over here it was an imbalance, right? This was a whole imbalance, price came back to it. So that's pretty much it about imbalances. Just treat it as a gap. Think about what if this candlestick wasn't here, what would have happened? This would have been a gap, right? So treat it as a gap, and that's the easiest way to do so. Like literally that's the easiest way to do so. So that's pretty much it. And do follow me on Instagram. If you have any questions, ask me on Telegram or Instagram. Contact me there. I'm always available almost 24/7. If I'm not, I'll surely definitely get back to you. So see you in the next video. Thank you. Hey guys, welcome to another video of this Smart Mini course, and today's video is called Train Your Eye. Now before we begin, I just want to say a disclaimer that Forex trading contains risk of real money. So that's pretty much it. Now please read the disclaimers, Google it and read it, that why Forex is risky and so on. Let's go. So to start with, I want to talk about what do I mean by training your eye. All right, so when I say train your eye, I basically mean that you must be able to find imbalances, institutional candlesticks. Sorry about my spelling, I'm really bad at it at times, so I'm sorry. And also whatever you call it, IC or say OB, whatever, order blocks. And you must also be able to find, liquidity. Or let's do it in steps, that'd be better. Try to find liquidity, IC or OB, whatever you want to call it, imbalances, and even better if you can find FU candlesticks, so that helps us out as well. And as you find liquidity, you can find FU candlesticks as well. And that's pretty much it. So training your eye, it means basically that you can find all these 3 at once in the same chart. All right, now also I just want to say, let me just have a look at it. Yep, okay. So also I want to talk about today about Fibonacci's. All right, now when I talk about training your eye, it means basically, let me show you an example. Say like this. I'll put in some examples at the end of the video, but for now let me just show you some like the regular examples that I try to show all the time on this one, right? So this is how it goes, right? Now when we look at this range down here, right? This range down here, we can use Fibonacci to get a better view out of it. So when I say that, what that means is basically you can use the last high and the last low to find. I'm gonna go deep within Fibonacci in the later videos, all right, and I'm gonna show you what I mean by an external range and an internal range. But right now we're just gonna talk about the last high and the last low. All right, so over here the last high is basically this, and the last low is basically this. So what you gotta do is you gotta mark up your Fibonacci tool. Yeah, this is a Fibonacci tool, just so you want to know. Fib retracement tool. All right, so you just gotta mark up the last high to the last low, because this is a selling scenario, or the last low to the last high if it's a buying scenario. All right, so when we do this, you can copy this the numbers. All right, I'm kind of blank right now. So the numbers over here that you need, just screenshot it and take the numbers and put it in, or pause the video and take it in. So what I mean by when I say last high to last low is basically we're gonna be targeting this area, especially this area, 70.50 to 88.6. This is a very like vital area where the market retraces a lot. What the retail tries to do is they try to sell near the 27 to 33 or 50% area. What we're gonna do is what I mostly do is 70 to 88. You can also do 60, 62 because it works a lot as well, a lot I would say. But me personally, I don't do unless it's 70 to 88 area. Now I'm gonna talk about every one of them in the later videos. As I said, I'm gonna describe Fibonacci more. So what you gotta practice right now is go to a chart and just play with it, like some setups. Try to find some setups. Try to find some try to train your eye to find the institutional candlesticks down here, right? And then what you do is probably find the liquidity. Where is the liquidity? Somewhere down here, right? So we're looking for the market to come down, right? When you find the liquidity, we're looking for the market to come down. Also, if you look at this price action down here, it captures liquidity so nicely and then comes back before going down, right? So it's pretty nice. So I'm just talking about like some basic stuff. This video is just to get you in the right mindset after so many videos, that you gotta try and master this stuff basically, where you can find the stuff and your eyes can catch it pretty well, Also over here, as you know, the last high to last low, what we can do is drop the Fibonacci from last high to last low, and you can see it basically touches the 78.60 and just flies down. So what we mark up is basically this, but over here we have an institutional candlestick. So this area is very powerful, from the wick to the wick down here, right? Because why? It's within our area, within the 78 as well, and most importantly, you can also have an imbalance down here, you see. So it's a very strong area right here, and I think if I go deep, I can find more imbalances within this area. So just practice like this, and I'm gonna show you how to practice in the next video, because that's gonna help a lot as well. This is pretty much it for the videos. I'm gonna leave some examples. Please look at them, and do subscribe and do follow me on Instagram. Hey guys, welcome to another new video of the Smart Money course, and today's video is called Identifying Buying or Selling Opportunities. And before I begin, I just want to give the disclaimer that Forex contains risk of real money. So trade at your own risk and read the disclaimers, Google it, and understand what Forex really is. Now, this is just a disclaimer I had to give every single video. Now let's begin. So in this video, I'm gonna talk about some important things. First of all, I'm gonna talk about how you can identify the if you're supposed to buy or sell. And secondly, I'm gonna talk a little about market structure, some important factors I'm gonna show you. This video might be around 8 to 9 minutes or a little longer, so let's begin. Now, at first, I wanna just get onto the charts directly and show you how you can be finding buying or selling setups in this market. While like how to identify if you're supposed to buy or sell. Now the first step to do so is basically to identify the market structure, right? So suppose, let's go like this and just roll this, right? Suppose the markets, now this, so far you should know this is a bearish structure, right? The market's trending downwards. So what do? We look for sells around this area, all right? We look for sells, not buys. You don't want to buy a market that's trending down. It's like trying to catch a falling knife. You don't want to do that because it's going to cut through your hand, right? So it's the same thing. You don't want to buy a falling knife, so you don't want to buy a falling trend or a bearish market. And the same applies to when you're trying to sell a rising trend. Now, usual retail people, they trying to sell high whenever they want to Like whenever they see a market go up, they think it's gonna come down. No, it doesn't have to. It doesn't always have to come down. They'll get this in your head that it doesn't always have to come down. Alright? It doesn't. It can just fly to the moon. Look at Tesla in this recent, or Bitcoin. It just flied. Even gold. Within this pandemic, it just went up and up and up. There was no stopping. Alright? If you look at Bitcoin go daily, like it's just crazy. Just look at this go. People might have been selling here. They've all been stopped out, right? It's just crazy how the market works. So you just have to accept it that it doesn't always have to come down. It doesn't always have to come down. Just accept that, because it's very important to do so. Now, what's important is, how do you identify the buying or selling structure? Now, the first thing to identify is just to identify the market structure. If it's I'm going to talk about bias in the next videos, not right now, because right now I just need you to practice how to look for setups. Then I'm going to talk about bias, because we have plenty of videos, right? So in this one, I'm basically going to show you how you can understand. Hey guys, sorry for the delay, I'm back again. Now let's get right into it. All right, now where was I was just saying that I'm going to show you how to get buying or selling opportunities, and how to understand which one to take and which one not to, and how to get through the phase. So now over here, for example, all right, we can see that this over down here, right, it created a lower low, right? Let me show you, for example, here, damn, bang, right, and down we go, right? So you can exactly see that the market is trending downwards. By looking at this chart, it's pretty simple that the market's trending downwards, right? It's creating lower lows and lower highs, right? Lower lows, lower highs, lower lows, lower highs, lower lows, right? So when you see this, the first thing that pops up into your head is basically that you want to look for a sell setup. Now, how do you do that? You just suppose the market's down here, right? My replay is not working for the time being. I don't know why. So we just gonna have to work it like this. I'm gonna make something better later maybe. So what we can see down here is basically liquidity being captured down here, right? So as soon as you see the setup, as soon as you realize that it's trending downwards, you're just gonna find, the first step is to find an institutional candlestick, which is this, right down here. And second, what you think about is, I'm gonna look for liquidity. Now you can see this is a lower low, right? This is a lower low, and the liquidity was captured down here, right? A lot of liquidity was captured down here, up here, sorry. Now this is a key zone, right? This institutional candlestick. So the first step, you go with institutional candlestick. Second, the first step is realizing what the market structure is. You look for a sell setup or buy setup. You see it's downtrending, you look for a sell setup. Now, how to find the exact setup, full setup, I'm gonna go and I'll go through my 12 steps later in the videos. But right now, I'm just gonna tell how to understand if you're supposed to sell or buy, and why you should not be buying when it's when the market's trending downwards or trending upwards. So now when the market's trending downwards, suppose down here, you could have bought in this area, right? This was an institutional candlestick, very nice movement up. You could have bought and thought that the market would have taken out these equal highs. These are equal highs, right? Now this is why I picked this example, because it's a great example, right? These are equal highs above, and you are thinking, if the market comes down, I'm gonna target those equal highs. But what you're not realizing is that the market is bearish. Now this is the first step. As soon as you see bearish, just write it down in your chart. It's bearish, so only sell, no buys. So this is the key. This is the key to 50% accuracy. Like, believe me or not, this is the only key to understand if the market's trending downwards or upwards. And this is basically the key of the accuracy in this concept, believe me or not, I'm gonna go more in depth within bias, higher time frame bias and lower time frame bias, but this is the key. This is the key, and I'm gonna go in depth in the later videos. So remember this, that you must understand when you're bearish, you don't buy. The only time, because if you look at this, it's clearly trending, what you call it, bearish, right? The only reason this is working out is because it's momentarily in 3 minutes or 5 minutes bullish, all right? And I'm gonna talk about that in the advanced market structure, so please follow that video, because it's gonna be really interesting and might be a little long as well. So you know, that basically is the key to understand if it's bearish or bullish, and go with the flow. You don't want to catch a falling knife, or you don't want to, you know, basically that's the key, man. I cannot stress this enough. That's the key. I cannot explain how many times, I cannot stress this enough, how many times I have done this mistake in my past when I was first starting, that I see an equal high and I want to just go and buy it. No, you first have to see the market structure, if it's trending downwards or upwards, and we can clearly see this is trending downwards. We don't buy, we wait for the market to come to us. It goes down, we wait for the good setup, we find it, we sell down here of the 50%, and bang, we are making like how much? If we sell at the 50%, I'm just gonna like you know, just do an eyeball, just eyeball it. I'm just gonna eyeball it. Wait, this is you know, the low is the target. Suppose it's 1:5, easy 1:5. Like if the low is the target, it's easy 1:5. Think about it, easy 1:5, and we can even lower the stop losses even more by going into the lower time frame. Maybe get even like you know, 1:15 or something. Like that is some crazy stuff, man. Believe me or not, that is crazy, just crazy. Like I cannot explain how good this looks. And this is basically the key, understanding where the market's trending and going with the flow, and this is gonna increase a lot of your accuracy. Please follow that. If it's bullish, look for bullish setups. If it's bearish, look for bearish setups. Try practicing, and I'll see you in the next video. Thank you. Please do follow my Instagram. I really appreciate it, and I'm gonna leave a lot of interesting facts in there. Thanks. Hey guys, welcome to another new video of this Smart Money course, and today we're gonna talk about, and today's topic is basically mitigation, or reimburse candlestick, or a breaker, whatever you want to call it. It's all the same thing. Now before I start, I just want to say a disclaimer that Forex trading contains real risk of money. So that's pretty much it. Google it, read the disclaimer that Forex contains risk of real money and there's risk in trading. So let's start and begin today's lesson. So I just want to begin with the fact that I hope you remember everything I taught you in the last few videos, and I hope you can catch everything with your eye right now and can find setups that look good, and you're going places basically. So if not, please do contact me, and I'm gonna help you all the time, all fucking time. So let's go. Now today's lesson is basically about mitigation or breaker. So there are three things, basically this. All right, now look at this. For example, I taught you guys how the market works, right? They have to buy to sell and so on. So when they are, say, selling to buy, all right, when they are selling to buy, there are times, let's do like this, sorry, my bad. When they're selling to buy, right, say like this, all right, yeah, this. So when they're doing this, when in this scenario, right, this is the candlestick, right? So when they're selling to buy, for example, this one, all right, this is the candlestick, this one, this is the candlestick, right, this blue candlestick. This is called a mitigation candlestick or reimburse candlestick. Let's write down mitigation, reimburse, or breaker, whatever you want to call it. All three people call it in different names. Anyway, I like to call it mitigation. Anyhow, so this candlestick is basically, they have positions down here, right? As we know, they got to buy to sell and sell to buy. So there are positions down here. There are many positions down here because they had to push the market down, right? They had to push the market down. That is why this candlestick was formed. Now, when after capturing the last liquidity, and this one, or maybe something down below down there, after capturing the last amount of liquidity, and just before they want to switch the structure, this usually happens. This is the key point, guys, write it down. This mitigation, reimburse, or breaker, whatever you want to call it, I'm going to call it mitigation, usually happens just before it's gonna change market structure, short-term structure, not long-term, just short-term, that time frame structure. Now, what do I mean by that? For example, down here, it was forming lower lows and lower highs until this happened. Look at this example. Bang, structure broken, bang. See, it turned bullish. So this usually happens just before the market structure is gonna change. Now, what is exactly happening here? We know there are positions down here. If you don't, just go and look at the previous videos about institutional candlesticks and so on. We know there are positions down here, total, every single one of them. There are orders down here, right, that they come back to close. Usually we take this candlestick, which is the last candlestick before the big move, but the orders, they're all down here, right? And there are orders down here as well because they had to push the move down. Now, what they're doing is, as you can see, while this candlestick was here, they never had the time, they never had the opportunity to stop here and close or balance this position out, right? Look at this area. They never came back here. They never had the time to stop. Look at this candlestick, right? They did not have the time to stop and just pass through it and then came back and closed their positions. So this is exactly what's happening. They could not have the time to stop and close their positions down here, which is why they had to come back and close their position. It's basically the same thing as an institutional candlestick, except it happens right before the stop hunt happens. Alright, it happens right before the stop hunt happens. So usually this happens just before the market structure is gonna change, and it's really a key because I don't really trade it. I don't really take trades with a mitigation candlestick, but it can help you while you're trading the lower time frames, or even you can go down to the lower time frames down here and try and find setups that will help you. Believe me, that will help you. You can master this. These are things you must know. It's nothing that you must trade. Everything you know, you must not trade, all right? But you should know. Knowing is a good habit, but you don't need to trade everything. As simple as you can keep it, it's better. But this, it helps. Like when you're looking at a chart, it will help you that why did this not come back down here? Because this is why, because there were positions down here and they were happy with closing their positions down here and going back. Look, it did come back to this institutional candlestick though, right? And then they went up. So this is basically an institutional this is basically a mitigation or reimburse or breaker candlestick, whatever you want to call it. Now let's look at other examples as well. Let's try and find some another example. For example, say this one, like, all right, so this one looks good. So what's happening down here is basically this was the whole move. There are positions down here, right? And there are positions down here as well, because you can see this is the breaker again, right? Just before the stop hunt happened. Just before the stop hunt happened, right? This is the position. Now this was the stop hunt. I'm expecting positions. I'm expecting it to come back down here to this candlestick. It does not. It just takes out these positions, Why? Because look at this candlestick, it never had the time to stop and close these positions that it had before, right? So what they do is they come back and closed all their positions. They took their time, they closed their positions, and then they went down. It's basically the same thing, except they're doing it with a breaker or mitigation instead of an institutional candlestick. I don't trade these, but it's good to know, and it helps when you're understanding the chart and when you're trying to trade the lower time frame. So this is pretty much it. See you in the next video. Please do follow me on Instagram. I'll appreciate it. I appreciate it a lot. Thank you. And if you have any questions, just knock me on Telegram. Hey guys, welcome to another video of the Smart Money course, and today's video is gonna be directional bias. And before I start, I gotta give this disclaimer that Forex contains risk of real money, and that's pretty much it. Let's begin. Alright, so directional bias is a really important thing to talk about. Why? Because first of all, if you master this directional bias, if you know directions, your accuracy already becomes really good. Say you have a 20% accuracy right now, or 30%, it's gonna be up to 50% better. That's how important directional bias is. Because why? Because if you already know what's gonna happen during the day to day, if it's gonna be bearish or bullish, you can look for setups based on that. Now let's explain how you can understand the directions and the directional bias. Basically, you're not always gonna be right. Of course, this is Forex, you cannot always be right, but most of the times you can be, and that's the key to this. All right, so let us think that this is a monthly chart. Okay, monthly chart. Now we all know there are different time frames, right? So many time frames over here: monthly, weekly, daily, 4 hour, 1 hour, 1 minute, many, right? Now what we're gonna do is we're gonna use the higher time frame charts, such as monthly, weekly, daily, and 4 hour, to understand the directions. Okay, where the market is heading, where should the market go. This is how we're gonna understand by looking at the higher time frame directions. Now let me explain how. So we already know how to find institutional candlesticks, liquidity, and so on, right? So let's say this is a monthly chart. All right, we can see that the market structure is bearish. It's trending, right? It's trending downwards. Higher lows and lower lows, right? Higher lows and lower lows. So that's how it's trending downwards. Now, as we can see it's trending downwards, we already know that the monthly is bearish, right? It's bearish. The monthly is bearish. Now, what is the weekly doing? Okay, this is how we find our setups. Look clearly and think clearly. Okay, we know the monthly is bearish right now. We can see it's heading downwards. Say there is some key level down here. Say there is an institutional candlestick somewhere around here. Okay, somewhere around, say over here, there's an institutional candlestick, and it's heading towards this one. Okay, let's do something like this. Okay, let's do something like this. Say it's heading towards this one. This is our key level. So we can see that the monthly is bearish. It's heading towards this level. Why? Because as we know, there are orders in here, right? Or maybe there could be a liquidity that it's heading towards. There could be many things. You already know what there are, such as the liquidity or institutional gains or imbalance. This could be anything that's heading towards, and we can see why. Because the structure is bearish. Higher lows and higher lows and lower lows, right? Lower highs and lower lows, right? So we know the monthly chart is bearish right now. You can see that. Now let's look at the weekly chart. What would the weekly chart be? Now what's important is to understand that over here, if the monthly looks like this, the weekly is gonna have some differences, such as this one. Say it's gonna have in between this higher small structures like this. Okay, so it's gonna have small structures like this. It's gonna have a structure break, small structure break, and something like this. This is the weekly chart. Remember, I'm gonna color it different way. Something like this. Okay, so this is how the weekly chart's gonna look. I'm gonna show it in charts so that you can understand better. Right now I'm just drawing it to give you an idea of what's actually happening. Say something like this. Okay, and this is basically a weekly chart. Okay, so this is how the weekly chart looks. Let's say this is how the weekly chart looks. Okay, now I know this is a bit confusing, but if we look at the weekly chart as well, it is bearish as well, right? Why? Higher lower highs and lower lows, right? Lower highs and lower lows, right? So this is how the weekly chart is gonna look. Why? Because the monthly has 4 weeks within it, right? And those weeks can be a little, what you call it, counter trending and then going down again. It's not just gonna be so simple that's up and down. No, it's gonna have its way, right? Now if you look at the daily chart, it's gonna be something a lot more different. Why? Because if the weekly had a counter trend like this, daily would have something like this, right? It's gonna have also a lot in here. Like it's gonna have a lot different chart, like something like this. But the overall, if you look, what's important in here to understand is basically, I know this looks very scrappy and very difficult to understand right now. You don't have to understand the market structure, it's not important. Right now, to understand the market structure is not important. What you have to understand is what I'm gonna show you. Just a minute. Look at this. This is the daily, right? And this is the daily, right? So let's look at this. So we can see what the daily is doing. We can see that it's basically following. I'm going to change this color. Monthly is going to be black, okay? Monthly is black, and the rest, this is say green is weekly, red is daily, okay? So daily chart, the daily chart, we can see there are so many structures, but over here it's bearish, right? And so we can also term this daily chart as bearish. But what's important to understand over here is, if you look at daily, weekly, and also 4 hour, which I'm going to show you, let's just draw the 4 hour right now. 4 hour is going to be really scrappy, like something like this. If you look at, my bad, sorry. So it's going to be really, so let's do blue, 4 hour blue, okay? So it's going to be very scrappy, like something like this, okay? Very scrappy. I cannot even draw it properly. It's going to be so scrappy if it really is. Like inside the daily chart. Why? Because there are so many days, right? There are so many days down here, like so many days that it's gonna be very different. I'm just trying to do it faster because, you know, let's select this. Okay, there's gonna be many setups within this chart, many setups. Okay, now let's look at this. 4 hour is bearish as well. 4 hour bearish. 4 hour. Okay. Now, what's important to understand over here is basically, if you look at all the 3 charts, where are they heading towards? Towards the candlestick down here, right? Towards the candlestick down here. And where did we get that from? From the monthly chart. How? We knew, if I just say, remove all this. This is a monthly chart, right? The monthly chart is what you call it. The monthly chart is bearish. We know that it's bearish. We can see the market structure. It's bearish. Now, if we bring the weekly chart, we can also see it's bearish. Why? Lower highs and lower lows, same thing. But where is it heading towards? This. And where did we get that from? From the monthly chart. So you see the direction. We are looking at the overall direction of the market. What is it trying to do? It's trying to go towards this area, right? Towards this area. It's trying to head towards this area, okay? So we got this from the monthly chart. We know the weekly chart is supporting it as well. The weekly is not creating higher highs and like this, nothing like this. It is also supporting it, right? It is also supporting it. And then we can bring the daily chart, which is the red one, and it's also heading towards. Now, difference between the daily and weekly chart and the monthly chart is you're gonna have a lot of higher highs, like structure change and bullishness in the daily chart as well, like this one, okay? However, what's happening is the overall direction is still bearish. Why? Because the monthly is bearish. So what's important here to understand is monthly is, let's write it this way, higher time frames always trumps to lower time frames. It's like when you play cards, you know, when you play cards, the spades always trumps the other ones, something like that. Okay, so monthly is greater than weekly, weekly is greater than daily, daily is greater than 4 hour, 4 hour is greater than 1 hour, 1 hour is greater than 15 minutes, 15 minutes is greater than 5 minutes, 5 minutes is greater than 1 minute, and so on, like something like that. Okay, so higher time frames always trumps the lower time frames. This is really important to understand, because when you know this, you already know the direction of the market, which is amazing to understand. Believe me, you're gonna be like, I'm 80 to 85% of the time I'm right with the directions. Like, believe me or not, 80 to 85, and that's why I can like break even more than lose, because that helps you to be on the right side of the market. Now, what's important here to understand again is that you are following the same direction, but you're literally doing the same thing. Okay, you're literally doing the same thing in every time frame. You're looking for institutional currency, liquidity, and so on, but you're taking the trade based on the monthly, weekly, and daily chart. So say over here we have all these balanced out. So if we take a trade, we're gonna take a bearish trade. We're gonna take a sell, not a buy. Why? Because we know the market's heading towards that. Now if we try to take a buy, we might, but that's gonna be very risky, riskier than this. This is way better than to take that. This is a high probable trade. To take a sell when it's all bearish is high probable. Now let's say daily was bullish and the rest was let's say daily is had structure breaks. Okay, like this. Let's say it has structure break like this in the end. So daily becomes bullish, right? But the overall time frame, as I said, trumps higher time frames, trumps the lower time frame. You're gonna see this is just a manipulation and it's gonna come down. This happens a lot. So what I prefer, what I personally do is take trades that has the same directions in every time frame. That is the key. Now I'm gonna show you an example. Okay, let me try and find an example for you. Alright guys, so here's an example of how you can use directional bias to your favor and find the right setups. Okay, so now over here we can see we are on the monthly chart and it's GBP USD. Okay, and we can first we have to analyze the monthly chart. Now what we can see in the monthly chart is here it captured liquidity. Okay, captured big liquidity. So let's first down. Now the monthly chart so far is bearish. Okay, it is bearish so far. If you look at this, so far it's bearish, right? However, we can see the trend change, right? We can see that it's trying to change, right? Liquidity capture, we are expecting a higher high and then bang. That's what we know. That's what we expect, right? Now what's happening here is the liquidity is captured, and at least even if it does not form this high, we can expect this. You can look at this just a second. Yeah, so you can look at this institutional candlestick right here, right? This is an institutional candlestick. Why? Because big institutional candlestick and then big move downwards, right? Big move downwards. So there's a lot of orders in here. So the monthly chart, we're looking at this. Now as this is happening, we can see that the structure is broken, right? The monthly structure over here is broken. What's happening? A higher high is formed, and as a higher high is formed, we are expecting now bullishness at least minimum till this area, till this monthly institutional candlestick or order block, whatever you want to call it. Okay, within this area. Okay, so we're expecting the market to come to this area for now. So I marked it up with this line and called it monthly IC open. This is how I do it, okay, personally. Now what we're gonna do next is go to the, let's first write it down. Let's try this one. Okay, monthly bullish. Okay, monthly is bullish. I want to keep it down here. Let's just okay. Now weekly, if we go here's weekly. What we can see on the weekly is, as I said, there's gonna be, look at the difference. Okay, look at the difference. This is monthly, only one price action. Now if you look at weekly, the price action, there's so many bullishness. Look at this, right, so many. There's literally three down here, 3 structure breaks. Now this was an area for a sell. It did not work out. what happened is the market's going upwards. As we can see, the liquidity is being captured. It's trying to push upwards. Okay, now this is our area. As you see, we have marked it up. Now on the weekly, we can also see it's bullish, right? What you can see is higher highs. A new higher high is formed up here, right? A new higher high is formed. Bodies, remember, bodies, not the week, not the wicks. So now we can write that weekly is bullish as well, right? And now we go back to daily. Sorry, my bad, daily, yeah. Now we go to daily and we can see the same thing, exactly the same thing. This is the whole monthly structure, right? But as I said, a lot of more structures down here. This is daily. Look at this, the difference in daily. So many, right? It formed a lower low and then came back up, and then again bullishness. So much different, right? Then liquidity capture. Sorry, my bad. Damn it. Now again, liquidity capture over here. Bang, liquidity capture again. See, the market's still bullish. Over here, if you were selling, if you start selling up here, let's say you start selling here, let's zoom in. Wait a second. Let's zoom in, alright? If we zoom in, say you start selling here because you thought this is structure, right? What happens? You sell, you were in profit, however, your direction is wrong, so you cannot get towards, say, this liquidity or say towards this liquidity. Why? Why? Because your direction is wrong. The direction, we can see that the market structure is bullish. Even though daily turned bearish for the moment, the weekly over here was bullish, right? As we saw, the weekly is bullish, but the daily was bearish momentarily. As I said, the daily price action has a lot of structures within it, while the weekly is gonna have 3 or 4, and the monthly is gonna have 1 or 2. So as I showed you, exactly that's what I'm showing. If you cannot relate, try and see this video again, okay? Try and see this video twice if needed, but understand this, that this structure break isn't really a structure break in the weekly time frame. It's only structure break in the daily time frame. So what's happening is, even though the daily turns bearish, the weekly is still bullish. So we have to, the higher time frame is always gonna trump the lower time frame. So lower time frame than that. So you're always gonna have to pick the higher time frame, the bias. So I would never sell this, even though it was in good profit, pretty good profit. But I would wait for a better buy, okay? Always a better buy, because sometimes it might not even work out. Probably might go up from here. You never know. You cannot predict the markets. You're just playing the orders, okay? Now, as we can see, this is bullish as well. New structure, right? New structure. We can see over here. Damn it. This is the whole structure. New structure, and we have this, right? So this is the last structure we have. Now, if we go to 4 hour now, let's write that down to daily bullish. I know this video is a little long, but it's kind of difficult to make you understand unless we take the time. Now we can see as we marked it up, my bad, I'm sorry, this was the last structure, right? This is the last structure on this. So if this is broken, it will be a break of structure, right? In the daily time frame. Okay, in the daily time frame. Now let's remove this right now. Now let's look at this. Over here we got liquidity capture, right? Liquidity capture, and I personally was expecting this, the market to be playing out from here. But look at this, for example. What happened? Market created double bottom. It took the liquidity out, as we know, and I was expecting the market to create a higher high and then come back down and go up, but it never created the higher high. What happened was it just created a lower high. So I wasn't convinced, okay? And what I did was I was waiting, and exactly that's what happened. The market went down. It went further down to capture this liquidity. Okay, to capture this liquidity. Liquidity down here. The money down here, basically all the money down here, okay? And basically this imbalance. Let me show you. This is a great example for this imbalance, okay? So it came back to this imbalance. Came back to this imbalance, and then the market. So look at these. We always have to target the key areas, okay? This was the last candlestick. before the whole move, literally the whole move that happened. This was the last candlestick before the whole damn move, and there was also an imbalance within it, right? Now what's happening is there was also an imbalance within it. I'm gonna change the color. I'm not liking the color. I'm sorry. Okay. So this was the last candlestick, which was powerful, and there was an imbalance with that. So if you notice these things, that's why I say practice liquidity, imbalance, and institutional candlestick. You gotta notice these things. If you don't, you're gonna miss out on so much. So I know you guys are trying to trade. A lot of you are trying to trade, but practice, man. Practice makes this perfect. Believe me or not, you're gonna spot. I sometimes don't spot these as well, even though I've been trading 2 years. But if you train your eye, you're gonna slowly you're gonna, just like me, sometimes I miss out, but I still do later on when practicing, when revising my trades. So do that, okay? So let's see what's happening. Daily is bullish. 4 hour, we can see it's bullish as well, right? It is bullish over here, right? Now what are we really expecting in 4 hour? We have 2 candlesticks to look up to, this one and this one, right? Now either of these, if the market retraces, we're going to take a trade, okay? If the market retraces. Now if we take a trade directly from this candlestick, and note, I'm going to show you in the later videos how to go to the lower time frames. For now, let's say we take it directly from the open of the candlestick, okay? And it's a big stop loss. I know it's a big stop loss, but let's just, our target is huge. Our target is basically as you know, wait, it's not here, shit, sorry. So our target is basically this candlestick, okay? So I'm showing you a long-term trade basically. This is not a short-term trade. I'm going to show you short-term trades in the bonus sessions, a lot of short-term trades. For now, I'm just showing you some long-term trades, okay? So this is a 1:6, and if we take from the, say, 50%, if it comes to 50%, it's gonna be a 1:8, I guess, yeah. And if we say what do you call it? So if we take it from the, say, 50%, it's gonna be pretty nice as well, okay? So if you take it from the 50%, say, and we put the stop loss around, say, the open of the imbalance, okay? That's a good one, like 10%. Or we can just put down below here. It's 1:8. Still pretty damn good, okay? Pretty damn good. Now I'm gonna teach you how to make it a bigger risk reward in the lower time frame sessions, okay? For now, let's just focus on this. What's happening next is you're focusing on these 2 areas. Now let's wait and see what happens, okay? Let's wait and see what happens. Why are we taking this area again? Because we know the daily is bullish, the weekly is bullish, the monthly is bullish, and we're just looking at these 2 areas now, okay? The 4 hour is bullish as well. Now look at this. This example is huge. We can see this structure. This is the first structure, okay? This is the first structure. Look at this. The structure is broken in the 4 hour. This was the first structure of the 4 hour, okay? The structure, and this is the second one. Now this is the internal structure, and this was broken, right? This was broken. This is 1 hour structure, or so this is broken. Body below goes below, but we're still digging a buy. Why? Because we know that the daily is bullish. So the bias says that the daily should not, if it goes below this, as I showed before, if it goes below this area, the structure of the daily is going to be broken. But the daily structure is not getting broken. Look at this. It take us in, and bang, just flies. The market just flies. It gives us a re-entry, slows, and just gone. This was another re-entry pre-close, but not count. Just gone. Look at this. Just gone. Now, what's important? We are already up 1:7. Okay, but look at this. What's important here is to understand that we broke the 4 hour structure. However, we took the trade from the daily bias. If I look at this, okay, for example, if I look at this, the daily, now if you look, I remember I drew this line, right? I drew this line over here and said if it closes below this, the daily structure is going to be broken. Now you can look at the 4 hour, and it wasn't. It broke 4-hour structure, no doubt. However, the daily bias, it never did. Why? Because the wicks are not the structure, the bodies are. Look at this. See? The bodies are the structure. The wick was just the This is the pure example of manipulation of smart money. This wick is the manipulation. If you look at it, how many can you even imagine how many sellers were trapped here? Can you even imagine? That's just crazy. Like crazy amount of sellers. This bank, same thing, yet again. As we all know how it works. Sorry for that. See? Also everyone trapped out. We get in after the move. Exactly here and gone. So this is just an example. I'm going to show you a lot more. I know this episode was a lot bigger, but I think it's going to help you guys. So I'm going to cut it off here. Hey guys, welcome to another video of the Smart Money course, and today's video is called Price Action. Now this is a pretty simple video. It's not going to be that big. Before I start, I just want to say that Forex contains risk of real money. This is a disclaimer. Please find it on your own and understand that this contains risk of real money and that past results do not guarantee future results. Okay, so let's begin and see what I'm trying to show you. Okay, now let's maybe start from here. Okay, so what I'm trying to show here basically in this video is that, as you know, sometimes say when you're picking out institutional candlesticks, suppose this one right here, or say you're picking out institutional candlesticks, many different ones. Let's find something. Let's say this one. Okay, let's say you're trying to sell and you found this one. Okay, but what's going on in this scenario is you are not selling before, say, before the structure is already broken, right? So after the structure is broken and you're trying to sell, which one would you pick? Would you be picking this one or that one, the above one? Of course this one. Why? Because what's important here to understand is that this candlestick has already been mitigated. Now what do I mean by mitigated? What mitigated means that the orders have been closed. Okay, so mitigated. Okay, let me write it down for you. Mitigated. Okay, mitigated. So what's happening, as you remember, I told you what mitigation is. I taught mitigation, so it's something like that. Order is being closed. Okay, now this, like the remorse candlestick, so basically what's happening is this order is already closed, so we don't expect the market to come back here. We're expecting it to come back here and go down. I'm going to try and find more examples for you. Let's wait and see. Also, one more thing to understand is try to pick candlesticks that are already not mitigated. That's what my point is, really, to try to pick. Let's, for example, say this one. Why are we picking this one and not something like, say, this one above or this one above? Because this has already been mitigated. Let's see, over here, right? This has already been mitigated. This candlestick and this candlestick, this has already closed all the orders down here. If you look at this candlestick went up to close all the orders that are here, but over here there were no candlesticks to close the orders. The time the candlestick came was this one, right? This is the time the candlestick came and closed the orders. Similarly, there are a lot of examples. Suppose this one right here, this has already been mitigated, right, down here, but this is not. This is not mitigated, and that's why we picked this. So this is basically understanding price action. Why am I telling you this? This is to understand that sometimes when you take setups, say like this, okay, and the setup's going like this, and you want to enter over here, okay, this is your entry, and what you're trying to do is you're waiting for the market. Instead of taking the setup here, you're waiting for the market to come back here in this institutional candlestick. Say there's an area over here, there's an institutional candlestick over here, say, and you're waiting for that. But what if it's already been mitigated out? Like, it's already been mitigated out here, so you don't have to really wait for that. Now this is really advanced thing, and you're gonna learn this as you progress. I cannot teach this. This is nothing teachable, to be very honest. This is something you gotta learn with your eye one by like day by day, day by day. This is really tough to teach. I can just give you an idea of what it is, and that's pretty much it. That's literally pretty much it. I cannot give you more than that. So yeah. Let's try more. Okay, let's try more. Say so let's say these ones. Okay, look at this. Look at this, for example. Let's move it down to this one. Okay, yeah. So look at this candlestick, or say this candlestick. Why don't we pick this and we are picking this one instead, this candlestick instead? Why? Because what's happening here is the same thing. This is not mitigated out. Okay, the orders, here's an imbalance. It's not been mitigated out. The orders are still here. There's an imbalance. You can see the imbalance, right? And what's happening is it left a key area, but over here these are already mitigated. Look at this, already mitigated, right? This, all the orders already closed over here. Now these sometimes works. I'm not saying it won't ever work. It does work, but the high, you want to take the high probable ones. That's what I do. That's why I'm winning more. Like, you're still gonna win if you take these as well. But what's happening is if you take the high probable ones, you have more opportunities and more opportunities to win. Basically, the better accuracy. Basically, you don't lose stupid trades, because once you start trading, you might lose a lot of stupid trades because you'd be so excited. Believe me or not, that's gonna happen. Look at this. Look at this. This happens, and then we expect the market. See, this has a reaction because it had some orders, but however, it's not enough, right? It had to come back down. It had to come back down and fill these orders in. So yeah, again, let me try and find some example. Sorry, my bad. Let's find an example where it worked. For example, this one, it worked. Look at this, it worked. Okay, but it was already mitigated out. And it worked, but it's not enough. That's what I've been saying. It's not enough. I think it's not hyperbabble, and that's why probably the market did not go up. Now I cannot assure this, but the reason I'm saying this is, as you understand the price action more of how the price has to be mitigated. Basically, if there are no key level areas, like for example over here, we can see that there is an area, right, available. So this is still valid. However, as long as over here, like for example this one, everything down here is already balanced, like literally from here to here, everything is balanced. This is the latest area that's not balanced, except for that. Down here, everything is balanced. This was mitigated out. This was mitigated out, right? This was, like, every one of them was balanced out. This is the only area, that's the new one, that's waiting for it to come back or come up and take it out. I don't know if it works out or not, but you understand what I mean. So balance price, understanding balance price action, the best way to do is try to look for imbalances. If there is no imbalance, you understand that that's a balanced price action. Okay, and balanced price, you don't want to trade a balanced price action because it's gonna go like a knife through it. Like, if this is balanced price action and this is the trade that's happening, it's gonna go like a knife. Literally, it's gonna fall that hard. So I personally, this is just a like probably the weirdest video you're gonna see in this course, but it is what it is, and you gotta learn this as you trade. See you in the next video, and thank you, and please follow me on Instagram. Hey guys, welcome to another video of the Smart Money course, and today's video is called Advanced Structure, Advanced Market Structure. And before we start, I just want to give this disclaimer that Forex contains risk of real money, and that past results do not guarantee future results. Now let's begin. Now in today's video, I'm going to be showing you some examples of market structure, how it works and how it can act different, and how you're supposed to study it so that you can get better at it. Now as I start, let me first show this. Okay, let me just begin and show this. So yeah, so let's say over here we got an uptrend, right? This is the market's bullish, creating higher highs and higher highs and lower highs and higher lows. I'm sorry, higher highs and higher lows. And what's happening here is, you can see sometimes it's gonna act like this. Okay, and then come back down and go up again. So sorry, we can end it here. Okay, yeah. So what's happening here is basically the market, you can see it's creating higher highs. Sorry, again, higher highs, right? So this is higher high, higher high, higher high, higher high, higher high, right? And this is actually the whole structure. Okay, this is the last higher low. This is the last higher low. Higher low, right? Higher low, higher low, and we got higher lows, higher low, and then we got another higher high, expecting for a new higher low, right? So what's happening here is basically you can see that over here market, this was liquidity capture. Okay, this was liquidity capture, right? There was money down here. So what market tried to do is, that's why I say that you cannot follow trend lines and so on. Okay, this is just a chart. Okay, I'm gonna show you in the charts. This is just a diagram basically, show you what's happening. Let's say there is an institutional candlestick over here, and the institutional candlestick also has and that's where the market comes back to. Okay, that's where the market comes back to. But what's happening is basically, you might think this is a higher low, right? And this is a higher high. You might think like this while trading, and this happens a lot. This happened to me for a long time. So you might think this, and then after this you might think, okay, it broke structure, I should go for sells. But actually what's happening is, it's just liquidity capture. And to understand what's a liquidity capture, you must first understand what liquidity is lying below here. For example, there could be an institutional candlestick here, but there is another one below, and this price action is not balanced out. Let's say it's not balanced out, okay? And the market left an imbalance down here as well, and say it has equal lows, or just say it's normal high low and high high, okay? But what the market did is basically, as what I'm trying to mean is, this is a valid area, this is an area as well, this is a valid area as well, but not necessarily means that it's gonna work out, because this price action, this higher high and higher low that you're looking at, is actually an higher high and a higher low from a different time frame. Let's say this is a 4-hour time frame, okay? And below, if we draw a 1-hour time frame, let's say same thing, right? But the 1-hour time frame is gonna have more, more price action within it, as I showed in the directional bias videos, right? It's gonna have more price action within it, something like this, right? So we're going the same way, but we're literally going the same way, higher highs and higher lows if you combine it, but we're having literally the more price action. So when something like this happens, it's basically going from here, okay? It's literally going from here. So now let me just give you an example. Wait, let's do this red color, okay? And if I put this together, you can see it's literally the same thing. It's literally the same thing, right? Higher high, higher low, higher high, higher low, again higher high, and this is what I'm talking about, higher low, and again higher. So basically it's literally the same thing. It's just to understand that this is 1-hour price action, or basically another price action of another time frame. That's the key. That is literally the key to understanding advanced structure, like market structure, when it comes to this. Let me get into the charts and show you some examples for the sake, okay? Let me first get rid of all these, okay? Yeah. So for example, this one, I showed you this example before, and this violates a lot, okay? Basically over here you can see that there was an imbalance down here, an institutional candlestick over here, right? So what's happening is, there was liquidity below this. As you know, every high and every low is a liquidity, right? Every high, as long as it's not mitigated, every high and every low is a liquidity. So what's happening here is, this is a zone, and this over here has an imbalance and institutional candlestick, but the market overall, the daily time frame is bullish. You can look at this. Wait, the daily time frame is bullish, right? Let me just remove this one. Look at this. The day, I'm going to show you one more example after this, don't worry. So the daily time frame is bullish, but now this is where bias helps, okay? This is where bias helps. But the 4-hour itself, if we draw the market structure, which is this, right? And what's happening is so it breaks structure here. Let me show you. It breaks. It's gonna break the structure. Look at this. Bang, structure broken, right? We have a structure broken over here, this one. And what's happening next is we're aiming downwards. Now you can sell here if you want to. If the market comes back, you can try and sell. But now if you think that the markets all, now this is where the key is, okay? This is where the key is. If you say, if the market came back up here, let's say the market came back up here and then went down, now that would have been a valid trade, right? Because why? The market structure in the 4-hour shifted, and your target cannot be this low. Your target has to be here. Why again? Because this is the zone we're looking at. This is the zone. This overall is the zone we want the market to be at. Okay, so this is where the key is. You have to understand the market structure of the time frames, different market structure, but following the same one of the higher time frame. That's where literally the key is. Let me get down to 1 hour and see how that price action looks, so I can guide you more within this. Let me see, and over here, right? Now look at this. The market structure of 1 hour is already broken, right? It's already bearish over here, right? It's already bearish, right? Now what's happening is this, we get confirmed market structure is broken, right? If it comes back here, we can sell it. If it doesn't, it doesn't. But let's say it did. If it did, it's a good sell. However, that's not what you're following of the bias. The bias says every one of them is bullish, okay? So literally that's the key. That's what I'm trying to get into your head, that to understand the bias and what the market structure, that the market structure is different in every time frame. Like it's the same thing but in different, but lives in a different way. For example, over here in 30 minutes, same chart, it was already broken down here. How? Lower low, right? Lower low, lower high, lower low, lower high. Now we can already be selling down here, selling up here, right? Or maybe wait for the market to come back here. But this was a good sell. This was a good sell if you took it, right? It was a good sell. I'm not saying you have to take it, but this is just to give you an idea of how the market structure is actually working, okay? It might be bearish in the 30 minute, 15 minute, but it is actually bullish in the 1 hour. So like over here, it already turned bearish, but we were looking at 1 hour as a bullish trend, right? So that's what I'm trying to make you understand, that it's gonna be different every time frame, and it does a lot of liquidity capture, like this one, exactly like the example I showed you. Damn, liquidity capture, look at this. Bang, liquidity capture, and then goes up. So to understand that, you must understand how the higher time frame is working, your higher time frame. That way you can understand what is the liquidity capture and what is actually a structure break. For me personally, when I first started trading, I was looking at these as a structure break. I used to think, oh, market turned bearish, now I can sell. I would probably take this sell then. However, look at this. It just flies up. It does not work out. The sell does not work out, right? Why not? Because the bias is bullish. The bias is bullish. And that helps you understand if it's liquidity capture, or is it just market structure breaking down. So this is a key. This is a big key to understand. Most of us would understand this is a breaker structure, would take this as a breaker structure, but it's not. It is not. You have to. It is a breaker structure in this time frame, but you have to understand that the bias, and that you cannot just look at this specific time frame and just go and trade it. You understand? That's basically the key to showing this. Let me try and find another example. Okay. Alright, so we have another example down here. Let me show you. Wait, let's go like this. Okay, let's go like this. Alright, so we have another example down here. Okay, so what this example is basically the same thing. Okay, let's look at this specifically like this. Let's go with this. Okay, we can see higher lows. The market is already trending downwards. If you look at this, if you look at this, the market's already trending downwards, okay, on every time frame. So what we're looking at is basically now the structure on this 4-hour time frame. If you look at the 4-hour time frame, it is bearish, right? It's bearish. We can see it's bearish. It's bearish, right? Still bearish. Now what the market does is tries to capture this liquidity and head on to this imbalance and then go down. Let me show you, for example, like this one. This is the imbalance, right? And within an institutional candlestick, we got both. So it is a very powerful one. Price has not been mitigated down here. It's still valid, okay? And what's happening next is basically this. Let me write it down. Wait. Lower low, right? So this is a lower low, and this is a lower low. This is a lower low as well, right? Now what's happening is we can call this a lower high low. Sorry, lower high. Lower high and lower high, right? And I say we don't have a lower high yet. We are expecting the market to go off this one. This is our next area to trade, right? But what the market does is, look at this. What the market does is it visits, bang, this area, this imbalance, this area. But now you might think, if you look at the line chart, this structure is broken, right? Structure, this was the structure break, right? Now you're thinking the structure is broken, but it's not. If you look at the daily time frame, it's not. Why not? This is the lower low, this is the lower high, and this is the new lower low, and now we're expecting a lower high again, right? And this is the lower high, and now we expect the market to go down. But in the 4-hour, the structure is broken. See, the structure was broken in the 4-hour, but that's not a structure. That is a structure break for the 4-hour, but as you know, the daily trumps the as far as the higher time frame trumps the lower time frame. So what's happening here is, even though this is a structure break in the 4-hour, it's actually a lower high in the daily. And to understand this even better, what we can do is look at this. For example, look at this. We have a target over here, right? What's happening in the 1-hour? Look at this. First structure break, okay? This is a structure. Let's get back to this example again. So what's happening is basically we can see that in the 1-hour, the structure is already broken, right? Over here, after creating a lower low in the daily, we can see the structure in 1 hour is broken. Now what we can do is we can first start trading this one, and if you want more if you want more confirmations, we can wait and see if it creates a higher low, right? It creates a higher low. So let's wait and see what happens. Okay, so it creates a higher high completely, and this is the higher low. And what we know is now that in the 1-hour, it's already bullish, right? We can now expect to trade somewhere around here as well, and we wait for the market to come back, and damn, it does, and bang, it goes up. Look at this. This could be our stop loss, right? And this is basically the entry. Now look at this. We might get stopped out over here, and that's fine. It's fine, because we are trying to trade against the trend. Remember, this trend overall is bearish. Daily, weekly, monthly, every one of them is bearish. Now what it did is basically captured this liquidity, came back down here, and then went up. It's basically doing the same thing as I said. Create a high and then capture the liquidity and go up. See? So liquidity and go up. And this is the best example of this. Why? Because there is no candlestick here. If you look at this, there is no candlestick. Even though the wick captured the liquidity, the candlesticks are above, so it's still a lower high. It's still a higher low, right? It's still a higher low, right? This is still a higher low, and this itself is still a higher low. This is a higher high, higher high. Let me just move this low. Yeah, still a higher high, right? So it's still a higher high. So, and what happens next is we can take this trade. And look at this. It's just we have two areas, this one and the one above, which is the imbalance with the 4-hour. But the market is already bullish in the 1-hour, right? It turned bullish in the 4-hour as well. Now, as it reaches our destination, we know that the daily is bearish, so market should not go above that. So if we took this trade here, if we took this trade here, our target should not be more than this. It should be max this, not more than that. Okay, not more than that. Why not? Because we know that the daily is bearish. It's still a 1:4, pretty nice, but look at this daily. Then what happens is it follows the daily's and now you're gonna get the best setups out of it. Look at this setup. Now you're gonna get the best setup out of this because you're trading with the trend. Trading with the trend, as I said, if you look at the bias video, we have excellent examples down there. So what I'm trying to mean is basically look at this liquidity capture, right? This every high and every low is a liquidity. So what's happening here is as this area is here, it came up. Now the thing is, you cannot know if it's gonna come up or not. It could have played out of this one. Okay, could have. You don't know, but there is a possibility that this might happen as well. So you have to understand that you are not wrong. The point of understanding this is that if you took this and you got stopped, you are not wrong. Okay, what the market, you cannot expect the market to do everything, right? You cannot expect the market to do everything because that's how it is. Basically, that's how it is. You cannot always know what's gonna happen in this market. So understanding this is the key, and if you know how to trade in the lower time frames, that itself would be a great key as well, because as I'm going to show how to take entries in the lower time frames, so you might not get stopped out here if you wait for the confirmations in the lower time frames. So that's basically it of the market structure, advanced market structure, to care about, to understand how the liquidity captures are done. This is the liquidity capture, right? So, and this is not a breakout structure, so understand that is really important. And that's pretty much it. See you in the next video. If you have questions, do let me know. I'm gonna help you out as much as possible. Hey guys, welcome to another video of the Smart Money course. In today's video we're gonna talk about divergence and what is divergence and how it works and so on. So before I start, I just want to give a disclaimer that Forex contains risk of real money, and that's pretty much it. Let's begin. So what is divergence? Okay, divergence is basically a reversal pattern. It's like a confirmation of reversal. Now, me personally, I rarely, very rarely use divergence, but it's something you should know. So I'm just teaching that. That's why. So because it helps. I very rarely use it, but I do sometimes, like very rarely. But now there are pairs that diverge together, such as EU and GU, like Euro USD and Pound USD, Australian dollar and New Zealand dollar, Euro Aus and New Zealand AUD, Euro NZD. Alright, so these pairs, they diverge. There are many other pairs like silver gold and basically pairs which correlate together. Okay, together they diverge a lot. Okay, so you can just Google and find which pair correlates with each other, or else in my in the PDF of what I'm gonna upload in this course, you're gonna have all these information of which pair diverges with each other. So that's gonna help you as well. Now I'm gonna upload a PDF, that'd be better. So now what is divergence really? So let's say this is Australian dollar. Okay, let's say this is Australian dollar. Okay, and this is New Zealand dollar. Now both are uptrending right now, right? Both are uptrending, both are creating higher highs and higher lows. But over here what happens is basically like this. Okay, so what we're seeing is, let's write down AUD USD, New Zealand dollar, and ZD USD. Okay, so there could be a different type of divergence. Okay, now the first thing to notice over here is this is a higher high, right? But in NZD USD it was a higher low, right? So when you're expecting, let's say you're expecting a reversal, okay, you're expecting the market to reverse to reach a peak peak point and reverse from, say, this area, okay, from this area. And what's happening is, as soon as both the pair gets to its area, one of them creates this and the other creates this. Now this is a sign of reversal. Like, say this is the daily or monthly or weekly, okay, and this is 4 hour, and in the 4 hour you can see that they are diverging right now. So this is a sign of reversal. That means market is weakening, okay, and they are trying to reverse now. They're trying to change the direction, and that is what basically divergence is. Now it could be something like this as well. It could be something like this. Say both created higher highs, but this created a lower low, but this one did not, okay, but this one created a lower high. Now this could be a sign of reversal as well. Now it completely depends on what you're trying to do. Like for here personally, as we said, we're trying to sell, right? We're trying to wait for a sell, and what happens is, as soon as the market gets here, we're waiting to see a divergence. Now this could be a divergence between these, and we could wait for a proper entry. We could wait for an entry somewhere around here, right, after the structure is broken, and bang, after the structure. And we don't take this, we take the one that's always better. We take the one that always looks better, not the one, basically the one that's ahead, okay. So as we are trying to sell and it creates a lower, so let's say a lower high, we're gonna take this one and not this one. Why? Because this looks better. This is already ahead of the market. So this is why divergence helps. I'm trying to keep it very short, because I don't think divergence is really that important to understand, but it's something you should know, and that's why I'm teaching it. So guys, here's an example of divergence, okay. So if you look at this, this is AUD USD green and red, and NZD USD blue and black. So what's happening here is, as it gets to this area, let's look at this area, okay. As it gets to this area, let's color this let's say orange. Oh sheesh. And let's color this somewhere around here. Yeah. So as it gets to the area, we can see that it's creating a divergence of what you got. We know we're trying to buy, okay, but what's happening is it's creating a divergence of a lower low. It's creating a lower low, while NZD USD is perfectly creating for this, right, perfectly creating a higher lows and higher highs, which is what we want. So we'd be trading this. Now this is just an example. I'm using it to show you, but I don't really use divergences that much because it confuses a lot. But I know it's really confusing, but it helps. Like say you want to buy here, and you can see that the market's creating lower lows, but in NZD USD at the same time, because the pairs correlate with each other, it's creating higher lows, which is a good sign. And divergence basically means that the pair is trying to respond, trying to reverse, trying to reverse. Basically, it's trying to change its direction. It's trying to do as it should do, you know. So that's a very good sign, and it does help if you know what you're doing, and it really does help if you actually know what you're trying to do, you know. So it's a great tool to use if you can master it. It's an amazing tool to use if you can master it. And that's pretty much over here. Again, if you can see that it creates a higher high, most of the higher high, and over here a higher low, like kinda, but like it's a really good thing to use if you know what you're doing. And but what I use it for is basically to understand if the reversals are coming in, you know. The reversals are coming in. But if you look at the two pairs, they're heading towards the same direction, right? They are both uptrending. Right? Both uptrending. But the pattern is different, and that helps us recognize if there are reversals coming in or not. So that's pretty much it about divergence. If you have more questions, just ask me. I'll try and answer about it. But it's not the best thing in the world, I guess. Not for me at least. But I think people should know it because it does help sometimes. So that's pretty much it. Thank you. Hey guys, welcome to another video of the Smart Money course, and today we are this session is called top-down analysis, and this is how basically you're gonna trade. Okay, this is how you're gonna be trading. This is how you're gonna be finding setups. Now that you know everything, this is an example of how you're gonna find the setups, and I'm gonna give 2 examples or maybe 3, a lot of them, like I'm gonna do a session of 30 to 1 hour minutes, so on the bonus session, so there's gonna be a lot in there. Right now on this one it's not gonna be much, but it's gonna give you an idea of how to find setups. Okay, now there are different types of trading you can do. Before we begin, of course, Forex contains risk, and this is a disclaimer. Forex contains risk of real money, so please read and be aware of that. Now, before we begin, what I want to say is there are basically three types of setups you can find. Okay, one is a long term, one is short term, another I don't know what to call it, so I just go scalping, but it's not scalping, it's like intraday. Okay, it's intraday. It's like you close in the same day you take it. Short term is basically what you do is say 1 to 3 days to hit take profit, and long term, say it's like swing, say 1 to 4 days, 1 to 7 days. Let's do that. Yeah, I don't know how to look, so I personally trade mostly short-term trades or intraday trades, like both. I don't really do swing trades. However, you can do them, and that's pretty easy. You just trade daily. Okay, now let's show you an example of how I trade personally and how I find my setups. Okay, so before I start, what I ask myself is like this: where is the money? What is their agenda? What is my trading range? What is price doing now? Where are they in drawdown? Higher time frame bias, break of structure, institutional candlestick, fibs, imbalance, captured liquidity, target liquidity. So I ask myself all these questions, and that's how I find my setup. And by now you should know all these answers, right? So let's give you an example. Let's say right now, if you look at this chart, it's gold, and what we can see is monthly. So we start with monthly. Okay, monthly is bullish, right? We can see it's completely bullish. There's an institutional candlestick over here, but it already has been touched and it already has been gone past through. So it's looking very bullish, and gold has been bullish. So we know that it's acting bullish because, as you can see, the overall trend has been bullish as well, right? So we can expect a higher high from this one, and that's pretty easy to understand if you know how market structure works. By now you should understand this, and the structure over here is bullish as well. It had a reaction from here, which is quite obvious. It should, but it's still bullish, right? So we have monthly bullish, monthly. I have to do this one here. Monthly bullish. Okay, just ignore the spelling mistake. Okay, so I'm just gonna fix it. Just a second. Monthly bullish, yeah. And what we do next is go to weekly, and weekly is gonna show us that weekly is gonna show us the same thing. It's bullish, right? We can see higher highs and higher lows, higher highs, higher low. This, remember, is not broken. Why? Because it's wick. The body has to close below, so it's still higher low, higher high. Now we're still bullish on the weekly, right? Same thing, bullish. Now it's retracing for this imbalance maybe, or this institutional candlestick. Let's see. Now weekly is bullish as well. We know that. We can see that the weekly is bullish as well. Weekly bullish, right? Now what we look at, the next thing is basically daily, and daily we can see the same thing, pretty much the same thing, right? Structure, this structure, this is structure, right? This is the actual structure. So it's still bullish, right? This is, look at this, still bullish, right? Still bullish. Higher lows, higher highs, higher lows, higher highs, higher lows, and now we're expecting a higher high. Now we're expecting a higher high. We're expecting a higher high. So we can write down daily is bullish as well, and we go down to the 4 hour. Okay, and how 4 hour works is now is same thing, pretty much the same thing. Okay, now we try to identify what's there, and before that we also identify if there's anything in the monthly chart. Okay, right now we're expecting a monthly higher high, but if you look at this, this is an equal highs, right? So we can mark that up as monthly equal highs. So that's a very powerful zone. As you know, it has a lot of money in it, right? That's what we know. Liquidity has a lot of money in it. So there's monthly equal highs. As you can see, it's weekly, monthly, whatever you want to call it, monthly equal highs. So that's very powerful. Now you go to daily. So that's our overall target, okay? That's our overall target, which is 1800. Now what we're looking at is now daily is trying to reach that zone. After that zone, it might react a bit. Now we're looking at we're looking at this one right now, which is 4 hour of this chart. Now we ask ourselves, where is the money? We know the money is at monthly equal highs, right? And we ask ourselves again, where is the money in this chart? And we can see we got equal highs up here, right? Equal highs up here. So this could be our first target, that could be our final target, okay? And now what we look at is basically let me just cut this down, okay? So we're looking at this and we have equal highs up here and equal highs up there. We got overall target and partial targets as well. Now we are trying to find what is their agenda. Their agenda is bullish, as we know, and the 4 hour chart is also bullish. We can see that, right? The 4 hour chart is also bullish. Our highs are right now. It's doing something like this. Now we can write down 4 hour chart. This is how you're supposed to find setups, okay? This is how you're supposed to find setups. Now 4 hours, but this is how I trade personally. Now what we're doing is, now look, this is complete price action trading. Complete price action. You cannot expect any indicators or something to work, because that's never gonna work. And if you want the easy route in Forex, you're gonna lose. And money is not something to be played with, right? So what's next is, what is my trading range? We can see our trading range is overall, as you know, this is the daily trading range, right? This bit is a daily trading range, but our internal trading range right now is this one, which is the internal trading range over here, right? This is our internal. Now this is the trading range we are working with right now, which is this, okay? So this is our trading range. You now know your trading range. Let's call it internal range, okay? So we're trading our trading range. Now, as you know, fibs, this is to use the fibs, okay? When you know your trading range, it's easy to use the fibs. Now what you can do is, what is price doing now? Price right now is bearish. Why? Because it's trying to retrace to this level, right? As we know, this is blue big institutional candlestick. So it's trying to retrace to this level. That's what we know. So what's price doing now? It's retracing. Okay, I ask myself these questions, and you should too. Now, where are they in drawdown? This is the important question, okay? So they are in drawdown down here, right? And this big candlestick. Now the question is, where are they in drawdown? We don't know where they are exactly in drawdown. We can only assume, right? We know they are in drawdown within this area, within this candlestick, but where exactly, we don't know. So what we can do is, we can do some things, which is, to start with, we can calculate the 50% of the candlestick, which comes below here, because this is a huge candlestick. If you take the trade here, it's gonna be a way big stop loss, which is not preferable. So here's the 50%. Now what else you can do is basically go down to the lower time frames, like 1 hour, 15 minutes, or 30 minutes. Let's go 1 hour and see what's there. We can see here's a little imbalance down here in the price section, okay? And we can see also nothing much really. Here's an imbalance. We can see here's an imbalance, and here's a zone. This is a key zone. This is a key zone, and we can also see an imbalance down here, or this candlestick. But I like this imbalance more, okay? Because this has been mitigated out. But there is a small imbalance which might work out as well. So we find these, and we try to go even lower to find if we can find something else. So we do find an institutional candlestick up down here, right, within an imbalance. So that's we're trying to narrow it down, because we don't know, like, we don't exactly know what's gonna happen, right? And within this imbalance, we find a very nice institutional candlestick over here, which has been mitigated, but it might work because it looks pretty nice, right? Below a liquidity, this is a liquidity, so it might work. And let's go and see in the 15 minute if we have something. Yeah, So 15 minute looks even better because this institutional candlestick is the last candlestick that was there before this whole big move, So it is super strong right now, right? So that might work as well. And this is super strong as well because this, if you notice properly, even though this is an imbalance here, these have been mitigated, right? So they don't necessarily have to come back there, but chances are they might. Why? Because it's still not mitigated, right? It's still there's still an imbalance down here. We can see there's an imbalance down there, right? So what we can now do is, and you can even go lower, like 5 minutes, 3 minutes, 1 minute, and try to find small imbalances within it to narrow down your trades. But the important thing to notice is that it won't always come back there, okay? So you have to accept it, that even if you narrow it down, it's not necessary that it has to come back there. So we got these two areas now, and what we're looking at is the next question: higher time frame bias. We already have our higher time frame bias, right? Monthly, weekly, all bullish. We are pretty good at it. Now we look at breakout structure. Did we have a breakout structure? Yes, we did. This was the last one, right? And actually we didn't. Actually, breakout structure, we did, but not entirely. Like, this was the breakout structure that happened, but this was the last higher high, right? So this was the last higher high. We did not necessarily break above it. So this is literally, like, it's not the perfect trade. I thought it was, but after looking at this, actually we did not break this, okay? But I think that's the daily market structure. What's happening here is, this is the breakout structure we're talking about, okay? So if you look at it this way, in this scenario, it's fine. It is fine. Even though if it broke above this, it would have been better. If it broke above this, it would have been better. But if even though this happened, this still is fine because the overall bias here is bullish. If the overall bias wasn't the same, then I wouldn't have taken this trade because of breakout structure. But as the overall bias is same, and this has a big chance to work out unless it wants to come back to this big imbalance, which for us this is a good area because if it doesn't work out, we can always buy here, you know, we can always accept a loss to get a better reward. So let's look at this, and what we got next is institutional candlestick. We already got it. We already got this one, and institutional candlestick here. Fibs. Now, as we know, this is our range, right? This is our range, and over here we are only looking at below the 50%. Why? Because this candlestick is huge. So over here I'd be marking up the 78 to 88, somewhere around here, right? That's what we trade, like, mostly. Yeah, so 78 to 88. Now what we're looking at is imbalance. Now already we marked up the imbalance over here, right? Over here there was an imbalance and we marked it up. Now we're looking at captured liquidity. There is captured liquidity, which is funny because it's right in front of our eyes over here, right? This is captured liquidity. This one is captured liquidity completely, right? And target liquidity, we got that. So basically, except for this breakout structure, which is also doable because it is a breakout structure, just not the perfect one. If this one was broken, it would have been perfect. Because right now, if you look at this is a lower high, right? Lower high, but this was broken and this was broken as well. So it's strong, but not as good as we expected. But as this liquidity is formed, I'm very, very confident, and that's why I'm trying to take this trade, okay? Because it got all the 11 confirmations except for this one, and personally, breakout structure is a huge confirmation for me. But on this scenario, it looks super good because it already has 4-hour breakout structure, not just daily one. Because I want the daily one, that would have been perfect. Now let's see what exactly happens, okay? We can see market turns out, market reacts, market comes back to this imbalance and flies. Market just touches the imbalance and flies, okay? Look at this, just touches the imbalance. Let's go to the 15 minutes, right? Was it 15 minutes? Yeah, I think it was 15 minutes. Let's see. Yeah, it was 15 minutes. Oh no, it was 30 minutes. That's my bad. Sorry. Yeah, it was 30 minutes. This institutional candlestick, right? And what happened was it just touches it. Let's remove this. It just touches it and fly. So this would have been a trade that has a reward of, say, and this is a big stop loss, but I'm just trying to show you like it's fine. The reward is still pretty big, 1:8, right? So this is pretty much a long-term trade. However, it only takes like maybe a day or two, like short-term trade actually. A long-term, this is the goal. 1800 is the goal. Monthly equal highs. Okay. So let's look at this for example. Let's remove this area, and we're looking at this one. What is? Why I did not take this area is it's not as powerful as this one. As you saw, the institutional candlestick, the imbalance. This area had no proper. This is an imbalance, but it's way above, right? It's not as powerful, and this isn't a proper institutional candlestick. It is, but it's not the one I'm looking for. I like to look for something that has proper width, something that's proper width, not two small ones. I like to look at something which is bigger, you know, something like say this one, something like this one. This would have been a great sell, by the way. Very nice sell. Liquidity capture, and gone over. Also liquidity. Let's show you this example. This would have been a great sell because it already broke structure. Like this is small time frame trade. Okay, I'm gonna show this. Wait a minute. Yeah. So we got this. Let's see how far it goes. I didn't really check it, so. Yeah, so it hit our target, the first target, and now it's heading for the long-term target, which is 1800. Let's see if it gets there. Can I fast forward a little? I don't think so. Yeah, I think it gets there as far as I remember. So these trades that I'm showing you, I actually took them. I actually took this trade back in, I don't know, April, May, and that's why I'm showing you. I'm looking at them from a journal and showing you because I don't really remember. I've not been trading lately, so I don't really remember any new charts. I actually took this trade. As far as I remember, I think I got there. Or did it? I don't think so. Oh yeah, it did not. It didn't. It came back. It came back. So we got the partials. We got the partials over here, which is a big win. Definitely a big damn win. It created a new high. So it was a 1:8. It was very nice. And this is how I trade personally. I asked myself these questions. And now I was telling you I'm going to show you this example. So let's try and show the other one, okay? This, we got it done. Let's show the other one. So this did not work out, sadly. Let's show this one. This is beautiful, man. I just love this. Looks so good. Okay, so let's get down to say 15 minutes. So on 1 hour. So let's start from here, okay? So what's happening here is I showed you guys a long-term or a short-term trade which took around 2 to 3 days to take profit, but it was 1:8, right? Now I'm going to show you a short-term trade. Now this is a short-term trade example, okay? Look at this. The structure has been broken, right? The structure has been broken, right? Structure is broken over here. Now if this was broken, it would have been better, but I don't think so. We would have gotten that entry though. So this structure was broken over here. Right, lower low is formed. Now we're expecting a lower high. Now remember, you're trading against the 4 hour. 4 hour is bullish, monthly is bullish. We have all this, but we're trading against it. Okay, we're trading against it because this is just for an example. Okay, how you can trade against it. I'm not saying you must, because I personally don't always do that. Very rarely do I do that, but you can. Now look at this. We got 1 hour bearish right now. 1 hour is bearish. What do we know? It's trying to revisit this area as we already, showed you. As I already showed you, it's trying to revisit this area 1 hour, right? So 1 hour is bearish right now, right? 1 hour is bearish. It's bearish. Now what we can do is we go to the 15 minutes and we can see better breakout structures. Look at this. Better breakout structures, right? The structure was broken here, and what's happening here is we got liquidity capture over here, This is very beautiful. Liquidity capture over here, right? And I can write down liquidity capture, and we also got liquidity over here. It formed a liquidity zone, right? Liquidity zone. So we got money down here and money taken above already. So what's happening is we're expecting bearishness, as we know 1 hour is bearish, and this is how you can trade intraday, or you can also trade through 4 hour, but this is a faster way of making money basically, if you think like that. So now we can look at, say, 4 hour. This 30-minute institutional candlestick looks nice. Or let's see, 45 minutes. Yeah, we got nice institutional candlesticks. This, we can use this as an area, right? Whole thing. As I said, I take 2 candlesticks when necessary. Over here we got the range. The range falls exactly at 78. This is the 70 level, right? This is the 70 level. You can mark that up as well. And what's happening is, where is the money? Money is above. Money is down below in this scenario, right? Money is down below. What is their agenda? Their agenda is bullish, but right now their agenda is to get back here. That's what we are thinking, right? Their overall agenda, monthly, weekly, daily, is bullish. However, the short-term agenda is bearish, so that's what we're trading. What is my trading range? Trading range is this, right? And what is price doing now? Price is retracing to head back here, right? To get to this area. Higher time frame bias, we are not respecting the higher time frame bias, so that's cut off. That's cut off right now. It's cut off. Breakout structure, yeah, beautiful breakout structure. We're expecting something like this. Institutional candlestick, yep, we got institutional candlestick here. Fibs, we got 78 fibs here. Imbalance, yep, we have a beautiful imbalance up here. If you look at it, we have a beautiful imbalance, right? Very nice. And captured liquidity, yes. Target liquidity, yes. We only are not respecting the higher time frame bias, which is okay in this case because we already know. We can already see the breakout structure has happened and it's trying to retrace. Now, why I don't consider trading like this is because sometimes this can be a liquidity capture and you don't know. So to understand the liquidity capture is really important. However, in this scenario, we can see that it created liquidity instead. As you can see, it created liquidity. So there's quite a strong zone that it should come back. Okay, so look what happens. It does come back, right? It does come back. Now it plays off this, I guess. I don't think so it comes back up, right? Does it? No. Sheesh. Okay, so let me see if there was a 15-minute candlestick. Ah, there was nothing. Sheesh, I lost it. Where was that? Sad. So this is an example of how you can miss trades, and you have to accept it because sometimes it's not gonna. Okay. So look at this. Over here, the 1 hour institutional candlestick was here. We did not notice that, right? The 1 hour institutional candlestick was here, and that's what has been played. So if we mark this up, let me mark that up again. I completely messed it up now. Yeah, so we can mark that up, and look at this. Where did that go again? Just a second. Yeah, so when we go to the 15 minutes, we can see this is the candlestick, right? Here's an imbalance. I'm not being able to go to 30 minutes, 5 minutes, or probably we have an institutional candlestick here, you know? And you could have traded that. You could have just traded this 1 hour candlestick over here and gotten an entry, which is at, is it still at 70 level though? Yeah, it's still at the 70 level. It just reacted at the 70 level, and you could have put their stop loss around here, or, you know, and wait for the entry. Basically it played out beautiful. If you look at it, just beautiful. So what it did is basically it came back to this 1 hour institutional candlestick and visited this imbalance within the candlestick, which is a very common thing and happens a lot. Okay, which is a very common thing and happens a lot. Like, these candlesticks tend to visit imbalances. Okay, makes sense. Look at this. All this has been already mitigated, right? This mitigated all this. So what's happening is this is the last zone that it had to visit, and that's what it tried to balance out. Now this we cannot predict, but what you can do is you can try and wait for it to react, which it did over here. You can see it did, and then enter of this candlestick. Okay, and that would give you even a better risk reward, which is basically entering of the lower time frame, as we know. So a 70 pip stop loss, which was here, turned out to be a 25 pip stop loss up here, right? So that's even better. And your target would be, first target would be this, and second target could be this area, or at least around here, around the same imbalance. So that's 1:13. See, that's how you trade intraday. If you look at this, so basically what happened is this played out during this session and basically took around how many hours? 1 day and 8 hours, and this one took around basically around a day, maybe not even a day. Yeah, 16 hours. So yeah, that's 1:6, so 1:7. So that's crazy reward, right? That is crazy reward if you think about it. And I'm gonna show a lot more examples in the coming sessions. So this is how you do your top-down analysis. This is how you're supposed to do this. Now think about how I trade. How I think is, when I take a trade, is basically how I think of it is, if I have, say, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, right? So if out of this 10 I have 10, I have 12, that's an excellent trade. If I have around, say, out of 12 I have around 10, I'm gonna give you the chart, around 10, that's a very good trade. If I have around 9, then that's a good trade. So I mark up my trades like this. So should I take it or not, I decide based on that. How many trades can I take? So if this trade, suppose, was in the opening of a month, I probably take it. I probably take a good trade, not the best trade in the world, but I take it. But if it was after me losing some, I only take excellent trades, like pretty high probable trades. And these are high probable trades as well, because we got 11 confirmations, right? We only missed I don't remember, what did we miss? We missed only the hard time frame bias in this one, and probably a breakout structure in that one, though that had it too as well, but not the best breakout structure in the world. So you get my point, and this is pretty much it from me in this video. And I'm gonna have a lot more videos in this course for you guys after this. After even the bonus sessions, I'm gonna try and add a lot more videos in this session, in this course. So I'll keep updating you guys. I did not mention this before, but I'll keep updating you guys and do more videos like this, so you guys keep learning throughout the month or so and so. And we're gonna do live sessions, and for now this is the top-down analysis. I'm gonna add 2 more bonus sessions, which is gonna be pretty big as well. And let's see you soon, and follow me on Instagram and also YouTube, because I'm gonna be uploading a lot more videos pretty soon.